Resting brain, shout out to you. Check to see if I'm on. Get me on the TV. Do all the stuff I need you to do. See, I'm online. Clearly see that 686 level where I want to take that put below the 686. I got an alarm set there at that area. I'd like to see a break and retest of it. In the past, it has shown a lot of support. Well, today being Friday, options expiring. Could be a beautiful setup. And to the upside, I said 689. but it's really closer to 690 as I look at it on this chart. It's going to be 690. Yep, 690.4 is where I like to get in. 689 call. 691. 5 first profit target. Alrighty, put an alarm here at 690 as well. Call. Okay, that's what I have. Those are my plans coming into today. Let's start off with this view. Oh, this is Greetings, traders. It is I, Abdul Shiba. Shout out to y'all this morning. Thank you for tuning in. As we are looking at what we are looking at right now this morning. Go ahead and share my plans with you guys. I already have my alarm set if you haven't noticed. Let me share my plans as well. Looking at a 690 call, 694 area. Like to take that to the 693. Ultimately 693. But I believe before that we'll go to the 691.3. So again, 689 strike, 690.4 entry, 691.3 first profit target, 693 second profit target. However, we are in a controlled selling algo right now out of the gate. If this does continue, I'm interested in a put if we break that 686. Watch out again for that white line that I have on the chart. Also keep in mind today is Friday. Yamu Jumu'ah, the best day of the week. And also the last trading day of the week where options do expire on Friday. So let us be aware and prepared. And more importantly, let us be patient and allow the market to present itself to us. I'll be back here on the mic at 9:45 as we get ready to look at that first opening morning setup. Shout out to the team. And I like how Ben goes, hey, CEO, that's me, Ben. Yes. Early morning rejection of that 688.5 has been a very key area. Also, let me show you my trading view algo as well. This is what I want to see on Trading View in order for me to seriously want to get involved in what is going on. I want to see, again, looking for a call in that 690 area. Believe we can take that right on back up, and looking for a put if we come on down to that 686 area. So this is what I'm looking at right now. I'm continuing to be patient as we look at the much bigger picture. This could very well just be a very nice pullback for a continuation back to the upside. And if it does decide to come down, I've already got my eyes on my target who's holding my money, and that is the 930 bulls from yesterday morning. I'm going to get those and get them in a position of being uncomfortable. I'll show that to you on another chart so you can see what that looks like as well. But those are my two areas. Calls above 690, put below 686. Thank you guys for hitting the like button. And I do have my alarm set in both of those areas. What I want to do now, however, it will throw off this controlled selling algo a little bit, but I want you to see what it looks like if we take off pre-market real quick, because we really could, kinda. Okay. It throws the algo off a little bit, but it's important that you see this way. Now you can see where my alarm is right above the white line here, why I like to call below the 686, that continuation move. You can also see the rejection right now from the 688, and the fact yesterday we did have a rejection here back to the 686. That possibly could happen as well. But there is some support here at the 687 area as well. Yesterday's support. So let me go ahead and put that in because that's important as well. Yesterday's support area. Okay. That's important. Alrighty. So this area is very important where and the market is responding to it just that fast. Let me go ahead. Alrighty, let's go with this view. Again, like I said, we really could leave out pre-market, even though it does kind of throw this algo off a little bit. There it is. Bam. We'll go with that view. Again, the market found that support at the 687. Right as I was drawing the line, the market drew that and found that support at the 687. So you can clearly see why I like the 686 for put. And you can also clearly see why I like above the 690. Okay, let's go ahead and buy high and sell higher. But for right now, with options expiring on Friday, I'm going to remain patient. But I do realize, as I showed you before, as I bring back in that trading view chart, this could simply just be a very nice pullback, potentially, for a move higher, as the bulls are very, very strong, coming all the way from 677. 677 all the way to 690. So this pullback here to 687 is a healthy pullback. Definitely not calling for a reversal, and need to see a lot more before I think about a put. But a call, on the other hand, I just need to simply see us break out of this control selling algo and then have a continuation move for me to want to get involved in a call. Anybody has anything else, please feel free to put it in the chat. The chat is open. The line is also available if anybody would like to call in. One of the new features that we are adding this year is the ability to call in and talk to the team. If you see something that you want to see or describe or talk about or questions, we do have that available. What's the number? What's the number? Just type it in. Alrighty, team. I will be back. Let's go ahead and show a different view too, real quick. I kind of want us to get ready for that ORB, see what that's looking like. Cause we have some ORB traders here in the building. Top right corner is the daily chart. You see, we had a gap down yesterday, ended as a doji. Gap down today. It really get hopping and popping. We get it closed below at 686. Get it hopping and popping. Until then, please be careful. Until then, please be careful. Bulls still have control of the week. This is still a bullish week. Bulls still have control of the week. Keep that in mind as well. All right. Left here, bottom left, we got the ORB. And this is very important. When we remove pre-market, we get a chance to see how the market is picking up from yesterday. Again, clearly supporting this 687 area. So let us just be patient and see what happens.
Good Friday morning. Welcome to Money Movers. I'm Carl Quintanilla alongside Contessa Brewer here at Post 9 of the New York Stock Exchange. Sarah Eisen's off today. Big techs in focus. Intel shares are down on these manufacturing troubles. NVIDIA's Jensen Huang planning a China trip in the coming days. And Meta, Microsoft, Tesla, Apple, and others all set to report next week.
Plus, almost half the U.S. now bracing for a massive winter storm. It's expected to bring a lot of snow, a lot of ice, and of course, along with that, power outages. We're joined by the CEO of Generac this hour to talk about how you are seeing a demand for those generators at home.
Gold prices closing in on $5K, not that far away after this blistering start to the year, up 14% so far. Goldman raises its target for the precious metal, citing strong demand from private sector investors, and we'll talk to the analyst behind that call. As for the markets, still trying to erase losses for the week. We're just about there at 69.29, would basically get you flat week on week. Dow's down about 220. Financials are definitely lagging today, down about 1% or more. Let's begin, though, with this move in Intel. Some soft guidance and some production concerns have shares under pressure. Our Kastrina Partsinevelos has more from the NASDAQ on this print last night. Hey, KP.
Hi, Carl. We have to say that there was a strong fourth quarter for data center demand, but like you said, they guided weaker first quarter revenue and gross margins. That initially hurt the stock, and then they also raised concerns about chip manufacturing yields, adding to the further demise. That's why you're seeing shares down 50%. But the stock had surged nearly, 20% right now in 3 months on government backing and turnaround optimism. It's up over 100% in the last year, but Intel got caught flat-footed by AI server demand. What do I mean by that? Well, management essentially admitted on the call, saying the company, quote, directionally wasn't managing the supply to an expectation that there would be unit increases that significantly increase in data centers. So Intel is pretty much telling us, which they warned us last quarter, that they're capacity constrained on older manufacturing processes where demand actually spiked. Processes they won't invest more in because that's not the future. So Intel essentially bet wrong on demand, can't quickly fix supply, and is kind of caught between maximizing today's business and pivoting to tomorrow's. CEO Lip-Bu Tam said chip yields remain, quote, below what I want them to be, meaning the percentage of functional chips needs to improve, and why you saw shares fall even further yesterday. The ramp of Intel's newest laptop processors is also hitting margins. A CFO called first quarter 34.5% gross margin guidance, quote, a pretty significant trough. And then on the foundry customers, this is a big one. I spoke to the CFO yesterday as well, Dave Zizner, and he told me not to expect any customer announcements anytime soon. The real signal will actually come from increased CapEx when customers actually commit, likely the second half of this year or the first half of 2027. But it's a chicken and egg scenario. The customers won't commit unless they're spending on the infrastructure. So what comes first? Bernstein analysts put it pretty bluntly in a note, quote, for a stock up 47% in 3 weeks, mostly on vibes and tweets, the print had to be perfect, and it was not. Intel trades at nearly 83 times 2027 earnings versus 27 times for the SMH, so you could say it's a little bit richly valued. Investors may need to wait longer for the turnaround they've already priced in, and that's why shares are down.
The street is somewhat constructive on it. A bunch of price target increases today. The defense KP appears to be, maybe their manufacturing production guide or forecast was off a bit, but that's maybe because it was such a financial basket case that they were trying to remedy back at the time. I mean, is that fair?
I'm sorry, I'm following. In financial basket case, in terms of they needed to cut costs, therefore.
The issue at hand when Lip-Bu first came in was about the financials, and maybe in the mess of all of that, the forecasting about production got a little bit lost.
So then, in other words, you're saying that management was too focused on cutting costs and bringing costs down, that they weren't actually focused on the supply of getting their goods out to customers, especially when we're seeing this peak AI demand. So I know I'm answering your question with a question, but that's the argument. Yes, the street was relatively positive. Things are improving with data centers. PC sales, there's still the refresh, even though things are down because of the memory pricing and maybe a lot of front orders were pulled forward. And you do have this, upbeat commentary about 14A, the more advanced manufacturing process. Things are going to pick up in the second half of this year, all that. But one of the analysts on the call really raised the point: why did they miss the mark? They make chips. chips. They have older processes to make said chips, and yet they weren't able to fulfill the demand. They went through all of their inventory, and they're saying in this current quarter, Q1, they're going to hit that peak supply issue.
I want to ask you here about NVIDIA. Got some good news from China in terms of allowing companies there to buy the H200 chips from NVIDIA. Talk to me about the impact on the company.
Yeah, NVIDIA has not confirmed this as of yet, but we know that there's been ongoing, almost every few days, a new headline saying that China has approved the H200 shipments. China has it. From my understanding and the reporting that I've done thus far, China's going to treat it on a case-by-case basis for a lot of the companies in China, but will give preferential treatment to the larger companies like ByteDance, Tencent, et cetera, so that they can purchase these chips for their large language models and be able to better compete in the AI infrastructure world, especially against the United States. You're seeing shares up perhaps 1% on this news, perhaps because NVIDIA shares have traded sideways for so long, and the next catalyst is going to be really Rubin and GTC in March. But overall, it's just this ongoing back and forth, and China is the gatekeeper, and we still haven't heard 100% that these sales will go through, but they most likely will, given all of these leaks here and there.
Christina, thank you very much for the wrap up there. Appreciate that. Let's get back to the broader markets as the S&P closes out a volatile week and tries to avoid its first back-to-back weekly loss since June. Right now, maybe tracking for a flattish week. Joining us now, Morgan Stanley Wealth Management Senior Vice President, Jim LeCamp. Jim, it's great to see you here. You painted this picture in your emails to us about this rodeo bull. Can you set the scene for our viewers about why you think this is one that's, despite the twists and turns and the ups and downs, it's a bull worth watching?
Yeah, it can be a market that's really hard to stick with because of the rapid fire news and the rapid fire changes in policy and Trump tariffs on, tariffs off, Greenland. These things can be very hard to keep up with, and it can lead people to think, oh, I better get out of this market. And this is a market that's had a big run anyway. But I would caution people about getting out of this market. It would be really rare for a market to experience a big bear with interest rates falling, earnings rising, the Fed in a cutting cycle while stocks are nearing an all-time high, and all the expansion that's going on in the market. So last couple of years, we had the Magnificent Seven. That was the only clean shirt in really a dirty laundry basket. Now we're seeing expansion everywhere. The biotechs are moving, the banks are moving, natural resources are moving, small caps are moving, mid caps are moving. And we have a lot of deregulation kicking in that's really helping these small and mid cap companies. In fact, we're seeing earnings expectations at 17% on mid caps, 19% on small caps for this year. That's a big turnaround from what we've seen out of these areas in the last several years. So we have a lot of good things going on, but there are a lot of fat tails on this rodeo bull. There's a lot of risks out there as well, and investors need to be aware of those too. I think they just need to stay with this market unless these things materialize.
When you're looking at the overall economy and where this goes, how much emphasis are you placing on the Fed and Fed independence as we move forward? And then things like, we're expecting a decision from the Supreme Court on whether the president overrode his authority where tariffs are concerned, but we're not going to get that decision right now. How much will that matter?
It'll matter. I mean, there are things that could really upset the apple cart here. When we talk about Trump's trying to run this economy as hot as he can. He's got a midterm, typically the markets sell off a little bit during the midterm year, but he's really trying to run this economy as hot as he can and still have the Fed in a position to lower interest rates. That's a very narrow path that he has to walk, and he's got a lot of stimulus coming in. It could be good. I mean, this one big, beautiful, bodacious bill has 100 to 150 billion of stimulus coming in for small businesses. We have deregulation coming in for small businesses. These are all good things for business, but it might get the economy in a spot where it's difficult to cut rates. And we need rate cuts for the banks to continue to rally, for private equity to do well, for real estate to do well, and for small caps to do well. So it's a really narrow path, and we need to watch these things. And look, if the Supreme Court's say that the tariffs are problematic and they're unconstitutional, that's just going to be a buying opportunity. I'm not worried as much about that. What I am worried about is our ability to control inflation and maintain this rate cutting cycle that we're in.
Yeah, well, we're certainly not expecting a cut next week, Jim, and some aren't
Right.
looking for one in the first half. You mentioned fat tails, and I'm curious what fat tails you think we should be on the lookout for.
One of the biggest ones, Carl, is the Japanese government bond market. Now, this was a trade that was a widowmaker for a couple of decades, really. But now yields seem to be getting away in Japan. And if that spills over to the rest of the world, particularly to the U.S., if we saw our 10-year Treasury push up to 5% or so, that's really going to be problematic for the market, and it's going to change a lot of the narratives for the market. So that's a big one. I'm not as worried about the Supreme Court decision. The other thing I'm worried about that could also impact the inflation rate is some of these things that the president is throwing out there, price controls, these credit card caps, that's going to limit consumer spending. It's going to limit the amount of credit cards that get issued. And they've been disastrous policies when we've implemented any sort of price control in the past. Also, this stimulus check can be inflationary, and that might get in the way of the Fed. So I think the president has to be careful about trying to stimulate the market too much at the same time that he's trying to get the Fed to cut rates. So that's another big one. And of course, we have geopolitical events that could happen at any time. It looks like we have a compromise in Greenland, but who knows what's next? It's a rapidly changing environment, and we need to be aware of it. But by and large, these conditions for the market are really pretty strong and pretty solid. And productivity is the main driver here. Companies are doing a lot more with less. AI is helping. And you had a lot of companies that hired a lot of people coming out of COVID, and then they figured out we don't need that many people. So they're doing more with less. And that's really strong for the economy, ultimately.
If you're riding a rodeo bull, you just got to wrap that rope around your hands and hang on. Jim, thank you.
At least 8 seconds, right?
8 seconds.
That's a very short-term outlook, Jim. Thanks. When we come back, T. Rowe Price helps us look ahead to next week's big tech earnings. We're going to get Meta, Microsoft, Tesla, Apple, and a bunch of others.
And then with more than a foot of snow expected to hit the East Coast over the weekend, and really, snow might be the least of our worries. Let's look at the potential impact on the power grid with the CEO of Generac. Plus, how insurance companies are bracing for this potential disaster. Don't go away.
Welcome back to Money Movers. Earnings season is going to heat up next week with a number of big tech names getting set to report, including Meta, Microsoft, and Apple. Our next guest manages T. Rowe Science and Tech Fund, which holds all those names. The fund, by the way, outperforming the Nas by more than 2% year to date. And joining us this morning is T. Rowe Science and Tech Fund portfolio manager Tony Wong. Tony, welcome back. Good to have you.
Thanks so much.
Sounds like one of your big thoughts is that this AI trade is not about picks and shovels anymore, and that's going to get reflected certainly in this quarter's results.
Hey, yeah, absolutely. Look, I think that one of the most exciting things that's happening is agentic AI, and the developments of Claude Code recently have been just pretty amazing. I mean, you think about the ability for these AI agents to do more iteration, more debugging, and when you can string them all together, and have them work together, like you have like kind of a digital labor force, which is, I think, really going to uncap productivity. And, you know, when you look at like large cap companies in tech, like, you know, the mega caps, they're really good at having the distribution. And so I think there's going to be some pretty interesting developments, and I'm excited to hear about what they say next week.
Now, of the names we mentioned, which ones strike you as the most interesting? And in the software space, can some of those innovations rescue these valuations that we keep worrying about?
Yeah, so I think it's going to be more important that these software companies are more the platform and not just a feature, because the coding in AI, I mean, it's just like creating a lot of, you know, it allows you to deflate the cost of coding, essentially. And so distribution is more important. If you're a feature, you can just get tucked into the platform. So, you know, I think Microsoft just owns, you know, the Office. And as a result, they have a big opportunity here to get these agents going. And so, you know, I think you want to stick to the bigger platforms as a result.
How much detail, how much color do you need to hear? Does the street need to hear from these companies when it comes to not only how they're using AI, but what they're getting back in terms of their AI? I mean, you're pointing out that Meta knows, Meta's using this and the market knows its cost, but not what its revenue is.
Yeah, so I think last earnings season, essentially, you know, the market was digesting the cost of AI and like the depreciation that's coming through, the amount that they're spending. And so what's TBD a little bit is just like the revenue that they get from it. So I think that's still the unknown here. And so, you know, there's definitely a chance that, you know, they see better ROI. I mean, essentially AI is really good at targeting kind of preferences, the algorithm, and maybe they get some agentic AI going as well. So, you know, I think that as a result, these platforms can continue to compound.
And a lot has been made about Apple sort of doing the slow burn on AI and letting everybody else sort of take the lead in the headlines and all of that. Is the pressure really on for Apple to show some demonstrable progress on implementing AI in its products and its software?
Yeah, so I think Apple is an amazing company that integrates the latest technology for consumers in a really elegant way. I mean, I think they're essentially making these ecosystem of tools, and as a result, I think they still, you know, really have a great place. You know, do they need to, you know, develop the large language model? You know, is that their strength? Perhaps not. I think they're going to partner like they did in search and, you know, with Google. So I think here, looking at that partnership's more solidified. Like, I think they can really be more front-footed with Siri, and so that's really exciting to me in terms of having that more integration into their products.
I wonder where you are, Tony, on memory prices affecting consumer electronics as it pertains to Apple. It's a slightly different story, but like shares of HP, we're back to COVID levels again, cracking below 20 today. Is that going to have a detrimental effect on the ability to price these things competitively?
Yeah, I mean, that's a great point that you bring up. Definitely very topical, and it's going to be, you know, questions asked on the earnings. And so I think that what really matters there is, you know, you have this new TAM for memory. That's AI, and these hyperscalers are scooping up a bunch of the memory. And so I think it's going to have a crowding out. I mean, the memory costs within consumer electronics, that's like already 20%. Of the bill of materials. So if that doubles, I think you're going to see some pivoting, some despecing, some increases in pricing, and it could like really hurt demand in some instances. So I think it's definitely something to watch for sure.
We've been talking this morning about Intel shares dropping after its lowered guidance for the quarter to come, about the supply constraints that it has reported. Is that a bottleneck that you're watching across the trade?
Yeah, definitely. So when you're looking go from 0 to 100 when you're building these AI data centers, and there's all sorts of bottlenecks that are going on. I think you're going to run into capacity constraints, and as a result, I think we're seeing that demand is not the issue. It's more like supply and execution. And in terms of Intel, I think they're continuing on their journey of the turnaround. I think Lip-Bu's done a great job. It's going to be a multi-quarter, multi-year effort, but to me, I actually heard more encouraging things. I think obviously the price got a little ahead of it, but the long-term story is still intact.
Hey, finally, Tony, what's the thesis on Meta right now? We've had a couple nice bounces somewhere in the $600 range. They've had to come clean on, reversing some ideas out of Reality Labs and the metaverse. I mean, has the street been forgiving enough?
Yeah, well, I think that whenever you're spending that much money on AI, it kind of acts as leverage. So when you have good results, it amplifies it. When you kind of come more in line, that often gets amplified as well. And they looks like they've reshuffled some things and reorganized. And so I think that the strength of the platform, as long as users are spending time, the attention is there. I think it's that they have a good pole position to capitalize on the opportunity. So I understand why Mark is spending a lot here, because it's probably risk of underinvestment and over the long term. And utilization continues to be really high in the industry, and so there's probably good optionality on building out that AI infrastructure as well.
Yeah. Well, we do have Threads engagement now surpassing X, which is a sort of a testament to their network theories. Tony, we'll see what next week brings. It's going to be crazy. Good to see you. Tony
Absolutely.
Wong.
Thank you.
Coming up. Its year-end gold target. We're going to talk with the firm's co-head of commodities about how high he thinks it can go. Gold has hit another new all-time high today. It's at 4,980 right now.
Plus, could the AI race be moving beyond chatbots? We'll look at the next frontier for AI growth and why the industry's biggest companies think it might be much more lucrative. Stay with us.
26 minutes past the hour. Let's get a news update now with Dom Chu. Hi, Dom.
Good morning, Contessa. So the man accused in the 2024 murder of the United Healthcare CEO, Brian Thompson, in a federal court hearing this hour. The judge in the case is expected to rule on the admissibility of key evidence in Luigi Mangioni's trial, including items seized from his backpack and statements he made to the police. Mangioni has pleaded not guilty to murder, stalking, and weapons charges. Police in Indiana announced the arrests of 5 people as part of the investigation into the shooting of a local judge and his wife last weekend. Both victims are in stable condition. Following the attack at their home, all 5 were arrested on charges of attempted murder and a range of other charges as well. Police have yet to reveal a motive. And a former Canadian Olympic snowboarder turned alleged drug kingpin arrested today. Ryan Wedding, who was on the FBI's 10 most wanted list, faces charges of running a transnational drug trafficking ring responsible for importing about 60 metric tons of cocaine into Los Angeles. FBI Director Kash Patel compared Wedding's alleged crimes to infamous drug lords Pablo Escobar and Joaquim El Chapo Guzman as well. An interesting development there. I'll send things, Carl, back over to you.
Tom, thanks very much. When we come back, some predictions say the East Coast might be hit with more than 16 inches of snow this weekend. We're going to look at the coming storm and the impact on the grid with the CEO Generac when Money Movers comes right back. Welcome back. This major storm expected to bring more than a foot of snow to the East Coast this weekend. AccuWeather's Bernie Rayno has more on the forecast. Bernie, we've been leaning on you big time today.
Yeah, well, Carl, it's coming. It's on the way. It's less than 48 hours away across the Northeast and less than 24 hours away across Texas. Look at the impacts of this storm. You talk about news you want to use here. How about 200 million impacted from this storm? Travel, flight is going to be shut down across the country Sunday and Monday. You will not be flying anywhere in the central and eastern U.S. I drew this line this morning, Chicago toward Houston, all the way toward the East Coast. Every airport within and east of that line will have some delays. Many airports will close. There will be ground stops. The only exception, South Florida. But no one's going anywhere flying both Sunday and Monday. And here's why. Freezing rain. Hundreds of thousands are going to lose power. And then we have the heavy snow from the southern plains into the mid-Atlantic and also the heavy populated I-95 corridor. The problem begins with this cold. This will have an impact as well, as it is one of the main ingredients for this storm. It's also going to test the power grid across the country. Look at the widespread cold from the plains toward the East Coast. Freezing temperatures, sub-freezing temperatures all the way down into the southeast and Texas, and look how widespread it is. The ice begins tonight, lasts into tomorrow across Texas. Look how far south it is, all the way down to Interstate 20 in the southeast. Then, as we get towards Saturday night and Sunday, we start talking about the Carolinas. There's going to be a lot of sleet with this. Sleet's not as bad as heavy rain, but it's whether it's sleet or whether it's heavy rain or a heavy freezing rain, there's going to be power outages. And remember the cold that we're going to be dealing with. Let's talk about the snow. One of the most widespread snowstorms that we've seen in recent years from the southern plains all the way toward the Northeast. A large area of 6 to 12 inches, Wichita, Kansas, Oklahoma City, all the way toward St. Louis and into Kentucky. This is going to be falling as we get into Saturday and Saturday night. And then Saturday night and Sunday, we start talking about the mid-Atlantic and the Northeast. A heavy snow. Listen to this. Snowfall rates within this area around Washington, D.C., Baltimore, Philadelphia, times will be 1 to 2 inches per hour. We have over 12-inch area, Harrisburg, extending in the central parts of Pennsylvania and into New England. Some specific accumulations for you. Baltimore, Washington, D.C., Philadelphia, 6 to 10 inches with sleet mixed in at the end. If it doesn't, sleet or that sleet is delayed, easily a foot of snow. We're talking about 4 to 8 inches in New York City with the potential for a foot, 8 to 12 in Long Island. How about nearly a foot of snow in Boston, Providence, and Hartford? And oh, by the way, within this blue area, we have an AccuWeather local storm max of over 2 feet, 30 inches of snow. Listen, make sure you have the AccuWeather app downloaded. We're going to keep you updated all weekend on this storm. But Carl and Contessa, a huge storm. And I talked about airport delays. Travel, roadways, a lot of these roadways will be compromised, and there's going to be major delays.
You know what, Bernie, I don't care how good AI is. AI is never going to replace a great weatherman. Thank you very much for that forecast. We really appreciate it. By the way, watch for the insurance impact from this storm as well, because those downed trees, collapsed roof, car crashes on icy roads, all of that can accumulate into sizable insured losses. I mean, if we look back at February 2021 and that polar vortex, it was one of the costliest winter disasters on record in the U.S. Nearly $15 billion, maybe as much as $17 billion, depending on how you calculate it, across states in insured losses. That's according to the Insurance Information Institute. And then Texas, hardest hit, $8.2 billion in insured losses, according to the Department of Insurance in Texas. The economic impact really can be higher because there are non-insured losses like business disruption. That's not covered under typical policies unless you have damage. You know, if you have frozen pipes in your business and you have to shut down, that's a covered event typically. But this is the time when, if you're a small business, you should be looking at the details in your insurance policy. By the way, you can get, and businesses do get, non-damage business disruption. That's a specialty line, Carl, where you go in and you say, it doesn't matter whether there's damage. If there's freezing weather that keeps people from getting to my business, or the power shutdown means that I can't open, then it would be covered, but it's expensive. The other thing is parametric insurance, which is kind of come out over the last decade or so. It's a special brand of insurance where it has nothing to do with damage. You don't have to show damage. All that matters is that the weather hits certain metrics. So a certain level of snowfall, the temperature drops to a certain degree. There would be an automatic payout in this case. And what's interesting, we saw from Milliman, this is a real municipal coverage, a policy that a city or a town took out that said if there's 0 to 19 inches, we wouldn't get anything. But look, if there's 20 to 30 inches of snow, we'd get $500,000. That might help pay for, say, salt and extra man hours in the plows. 30 to 40 inches, that would be $1 million payout. That's how parametric insurance works. And of course, we just heard from Travelers this week, which notched an impressive earnings beat for the quarter. Progressive, Aon, Hartford among the insurers reporting earnings next week. So we may get color, even though it doesn't affect the quarter, about the insurance impact there. For more on the storm's impact, let's bring in Generac CEO Aaron Jagdfeld. When we're talking, Aaron, here about the impact on the power grid, that dropping temperature, I mean, when you're seeing temperatures getting in the single digits, that's when we're getting frozen pipes and the like, and where I know you're going to say a generator can make a big difference.
Yeah, that's exactly right, Contessa. I think a big chunk of, you referred back to the February 2021 polar vortex and the losses in particular in Texas. A lot of that was frozen pipes and the damage that comes from, the loss of power, and your water, and the damage that comes from flooding, that comes from, those, having to redo an entire lower level or a whole home. A lot of that damage is preventable if you do have a backup power source like a generator or a battery.
We know from the data itself that the severity and the frequency of these climate events, where there is damage, whether it's from hail or wildfires or hurricanes, that they're increasing. Have you seen an upward trend in people buying generators ahead of a storm, or do you mostly see surges when a storm like this is predicted?
Well, we see both. I mean, let's call it what it is. I mean, most people are, we react to the environment and the things that happen around us, right? So about 20% of the populace will plan. So, they'll think in advance of, and a lot of that comes from experience. If you've experienced an outage, if you're a homeowner, the damage that can happen or has happened in the past, you're more likely to try and plan for that event, and you go out and maybe buy a home standby generator, a whole home generator. A lot of times, though, what happens in these types of events is people wait till the power goes out. They don't think it's going to happen to them. It happens to them, and then they run out and they scramble and try and find a portable generator or something that can make power for them to help them kind of bridge the gap. And the problem here is winter outages are kind of special, right? I mean, in the summer when outages happen from hurricanes, things like that, I mean, it's a little bit more survivable. You can open a window, you can kind of make things, you can make do. Winter's a whole different ballgame. And in particular, if you look at the temperatures that are forecasted after this event, you're talking about a week long of, really freezing temperatures in areas of the country that just are not equipped to handle that.
Right. Yeah, definitely you don't want to open the window in Texas this weekend, Aaron. I do wonder about inventory and production, where we stand in terms of retail inventory and whether or not things like tariffs have allowed you to produce as much as you've wanted to at the cost you want to.
Yeah, it's a great question. So 2 separate questions. The inventory position, we're actually in a really good spot from an inventory position. We actually didn't have a landed hurricane this past fall. So, some of the inventory that might have otherwise been sold through back in the fall during a normal season, we didn't get that this year. But we're actually, for something like this event, by the way, is kind of akin to a hurricane. You look at the planning that's going on and the forecasting. We've been talking about this really since the beginning of the week, this storm hitting. It feels like we're talking about a hurricane in terms of the amount of time we've been able to prepare. So I think we've got plenty of inventory. We're in good shape there. We can spool up production quickly. Tariffs impacted like every company. They impacted us. We have a global supply chain, and we've tried to reshore production to the U.S. as much as we can, but we have had to raise prices as a result of all the tariff increases over the last, certainly over the last year, but really this is something that's going back, 6, 7, 8 years. And we're trying to change our supply chain to mitigate that. Obviously, we don't want to pass that along to customers if we can avoid that.
Aaron, I'm curious. We've seen storms. Take, for instance, Superstorm Sandy when it came in and it knocked out power to gas stations. So even if you had a generator, you couldn't just easily go out and get the fuel you needed to keep your generator running. Nat gas this week is on a tear. I mean, that really matters to people who have those whole house generators and may have them plugged into propane tanks or natural gas. Have there been innovations in the way generators run and how long they can run on existing fuel?
Yeah, so if you're connected to the pipeline, so if you've got a home standby generator, you're connected to the pipeline, you can run that as long as pipeline gas is available. And that's, we talk about grids, we're always talking about the electrical grid, but there's actually a gas grid as well. And the reliability of the gas grid is fantastic. I mean, it's very, very strong that way. And so we see very few interruptions there. If natural gas is not available in your area, and we see this in areas of the country like Florida, some of the parts of the Northeast where you don't have a gas grid available, you can run off of an LP tank. And these machines have become a lot more efficient over the last several years. So you can get a week's worth of power, just from a typical propane tank underneath the unit. That's the way to do it. I mean, you're right. Gasoline is really hard to come by. If you have widespread outages, I mean, first of all, just the logistics to get to a gas station. You're talking about ice that's going to be on the roadways. It's a dangerous situation to even leave the home. If you're going out and trying to find gasoline, though, and there's widespread outages, you're going to struggle with that. And we've seen that pattern over and over again. And it's really why we encourage people to invest in the whole home generator, fully automatic, protects your home, protects your family, and runs off of your home's fuel supply.
Aaron, it's great to talk to you. I know that you've got extra staff members on call to answer questions and for your customers to be able to have that as a resource. It's going to be a busy weekend for you. Thank you.
Thank you very much.
Still to come this morning, the next gold mine in the AI race may not be chatbots. How the industry's leading companies are now focusing on a different end game that might be much more lucrative. Tech Check has that after the break. OpenAI's chief Sam Altman now touting a fast-growing part of the business that's separate from ChatGPT as this AI race now shifts beyond chatbots. Our Deirdre Bosa explains in today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So Altman's not the only one talking about this. Google's Gemini has also been growing this metric, and you're going to start hearing a lot more about it. So the metric is API usage, how often the model is being used by enterprise and by developers who are using OpenAI technology to run their own products. So instead of human typing in a prompt, the software talks directly to the API. One system sends a request, the AI sends back an answer. When a company uses an API, the model, that could be ChatGPT or Gemini or Claude, it's running inside. It could be inside enterprise software, drug discovery tools, scientific simulations. It's essentially the back end where AI could really drive breakthroughs. It's also one that could be a whole lot more lucrative for OpenAI and transformative for the industry as a whole. Then came the controversial part, though, as is often the case with OpenAI. CFO Sarah Friar, she suggested that she sees a new opportunity in APIs, and that is a value exchange model. In other words, OpenAI could take a cut of its customers' AI-aided discoveries. Now, some of the immediate feedback pointed to the irony of OpenAI scraping vast amounts of copyrighted data to train its models and then turning around and asking for a share of the value created on top of that intelligence. But another way of looking at it is that this is exactly how frontier technology gets funded at scale. That is by tying the economics of the model to the breakthroughs that it helps to unlock. Now, this all raises a bigger question, guys, about AI economics, who owns the inputs, who gets paid for the outcomes, not to mention the mechanics of actually executing this kind of a model. Seen together, though, and here's maybe the big takeaway at the moment, because this is still far away. You had ads earlier this week. Now you have Friar floating another kind of business model. It really shows the pressure that is on OpenAI to find revenue models that are big enough to support its commitments, more than $1 trillion of commitments that are already locked in. So you see a ramp up and sort of these ideas and how to just create more money and pay for everything it wants to achieve.
On a micro level, then what happens, like, for instance, I asked my AI a question,
right,
and it used an article that I had written for CNBC.com as the answer. So what, you know, like, who should get a piece of that revenue?
That's exactly the irony. Well, that's what many are pointing out, right, is that OpenAI basically scraped the web, all of the articles, everything that was copyrighted, vast amounts of this kind of copyrighted data to build the model, and now it wants to charge people using its model. So, Contessa, you hit the irony exactly. That's why people are kind of upset about the entire idea. But I guess the thinking is like, what's done is done. Where do we go next? If OpenAI models can enable these huge scientific discoveries, that's great, and maybe they deserve more of a cut. But you know, you're not wrong, certainly.
For me, it was like a philosophical breakthrough from the heavens. Like, the question you ask, the answer you already know. That's all I'm saying.
Well, okay, but you did ask on a micro level, Contessa. So, like, the idea going forward is, what if you vibe code an app and you create an app that ends up making a ton of money? Should OpenAI be able to take a piece of that? I don't think that's where they're going with this. It's probably like on a bigger partnership scale, and that's what Sarah Friar floated, is working with drug discovery companies, big pharmaceutical companies. So, you know, you'd have to sort of negotiate this ahead of time. I don't think that they're going to be taking cuts from, you know, ordinary people, although it is interesting to think about how that's formed in the past. Like the App Store, right, does take not a revenue share, but a cut of payments.
It's all it's a whole new world out there, Deirdre. Thank you so much for joining us today with that Tech Check. I mostly just wanted to share my own.
Yes, it's about me.
Up next, Goldman hiking its year-end target for gold. Its co-head of commodities tells us how high he thinks it can go, with metal hitting another new all-time high this morning. Don't go away.
Welcome back. Goldman Sachs just raised its price target on gold to $5,400 as the commodity continues to hit record highs. Joining us this morning is Goldman's co-head of global commodities research, Don Striven, who I think, Don, had a 4,900 coming into the year, got there pretty quickly. I'm assuming a lot quicker than you expected. Don, we'll work on your audio in a moment. They had 4,900 for year end.
Oh, there you go.
Don,
Okay.
I think we got you. Sorry, can you start again?
Yes. So the key upside risk to our structurally bullish gold call, namely the possibility that diversification would broaden from the official sector, from central banks to the private sector, to investors, that upside risk has been realized. We continue to look for significant additional upside from here, primarily because we think that higher central bank demand is
Yeah.
We'll continue to work on some of the audio issues with Don and his hit. That is the central thesis behind a lot of the gains, has been central banks hedging, looking for optionality against the dollar, and it's whether it's that or a hedge against inflation, among some others, have both fed this incredible run.
But to his point, which we did hear about the private investors, the retail investor jumping into gold, and the way that is something that we're watching unfold. Carly Garner, who is a commodity analyst and on with Jim Cramer on Mad Money all the time, has just posted, quote, "This isn't normal. It's scary. There are good reasons to be long metals, but there is no reasonable fundamental justification for these prices and this environment. They've GameStopped our commodities." I mean, it is ringing a bell once you start to see everyone piling into precious metals. And silver, which they say, look, this is really an industrial metal. Silver is
and platinum too, much more industrial use case, although it's cracking 100 for the first time today. Pretty historic. By the way, you got to put gold's week into some perspective. 49.81 is a remarkable number, but it's also the best week for gold since really COVID launched in March of 2020.
Yeah, Dan, I think we have you back now and hopefully have those audio issues resolved. You were just saying that you are seeing the private retail investors jumping in right now. For how long does that drive the price higher, you think?
Yeah, so our forecast of additional price gains to $5,400 assumes no additional private sector diversification. It's really driven, our bullish call, by central banks continuing to buy more for longer and Fed cuts. And so if this trend to private sector diversification were to continue, there would be upside to our bullish gold forecast.
Do you think at this point that I had just mentioned another commodities analyst who says that this has just basically become a meme trade, that they've GameStopped our commodities. Do you agree?
The rally has definitely gone faster than what expected. And we do think that the outlook for silver prices, which sort of lack this central bank demand anchor, looks particularly uncertain. And we think that the volatility will continue there. In the silver market, you also have a lack of liquidity in the London market, where inventories are very low because a lot of the metal has gone to the US. I do think that on the gold side, the structural trend of higher central bank demand, in combination with very stable supply, with annual gold production being 100 times smaller than the stock of outstanding gold, we do think that the path for gold prices from here is higher. But with private sector investors coming into the market, I think there is more uncertainty. Some of these flows are harder to track, and the risks are somewhat more two-sided. But our assumption is that macro policy uncertainty, for instance, around global fiscal policy outlook, won't be fully resolved this year. And so we don't assume liquidation, we don't assume selling of those global macro policy hedges, but we don't assume any additional buying neither. Our bullish call is very much a central bank driven demand call.
Yes. Well, you guys have been directionally correct. There's no doubt about that. We'll see how far we get as we work our way further into the year, Don. Apologies for the tech issues, but good to get your thoughts. Don Striven over at Goldman. Next week's going to be nuts. We'll start out with some big industrial names, UNH, GM.
Tesla, Meta, got a lot of earnings next week.
And then somewhere in there, we'll squeeze in a Fed decision. Market obviously not counting on a cut, but we'll see what happens. Have a great weekend. Stay warm. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour of the turbulent week for stocks and all that lies ahead as mega cap earnings loom large. Of course, the Fed meeting, as Carl just mentioned. We trade it all with the investment committee as usual. Joining me for the hour today, Stephen Weiss, Jim Lebenthal, Kevin Simpson, and Bryn Talkington. Check the markets. We are trying for 3 straight up days, and right now we have it, at least if you look at the S&P 500. Which is holding on to 6,900, albeit slightly, I guess. But here's what looms. Let's go to the wall. Because mega cap earnings are looming large, starting on Wednesday. Meta, Microsoft, Tesla. Thursday brings us Apple. You all know by now, you got to wait a while for NVIDIA. But these are the ones right now, Bryn, that matter. They always matter. I feel like maybe they matter even more. Why? Because tech has lagged so much to start the year. Nowhere to be seen on the best performing sectors list, where energy leads the way and materials is next, and industrials follow that, and then on and on and on. And then you finally get to tech, which is down 1.25% to start the year. What do you think?
Well, it's been a great 1, 3, 5, and 10 years for tech. So it's nice that some other sectors are actually starting to perform and pull up the weight. You know, I own all those stocks except Meta. I agree with you. I think next week is going to be incredibly important. Meta does not have a cloud, so they have advertising. So we're going to need to hear how they're going to monetize all of that spend. I mean, is this going to be a Metaverse 2.0? You have Microsoft, which is in the software space, which everyone's like, software is dead because of Claude. And so with Apple, looks terrible technically. And so I think you have this, very distinct set of circumstances with these companies next week. And I think investors want to know, do I want to keep these heavy positions or do I want to continue to diversify? And so the jury's still out, but I do agree this is going to be really important for all 3 of those. I feel Tesla is less important because we're more interested in like what's happening with robotaxis. We know that earnings I don't think are going to be great from car sales, but the investors have been more than happy to discount that and say, we will give this stock a high multiple because of the future earnings of Optimus, robotaxis, and Cybercab.
Let's show you once again the mega cap performance year to date, just to give you a scorecard on what we're talking about here. You know about this huge run in Alphabet, which is up 5.5% year to date. It's picked up right where it left off in 2025. Amazon, has it woken up? Maybe. It's up 4%. You could make the case, I think Bryn's right, that Meta is the most important next week just because of that big slide last quarter. Weiss, you take a look at that. Could you make the case that it's Meta? Remember the stock?
Yeah.
What it did after earnings last time? Because, Mark Zuckerberg, they talked about all the spending that they're going to do. Could you make the case it's Apple, which is off for 8 straight weeks? They have a lot to say. Could you make the case it's Amazon, which did next to nothing last year but is off to a good start? Maybe Microsoft, stock up 5% or so in the last 12 months. There's a lot going on here, and a lot to.
I had one opportunity, Ben, but I let it go by. Looking at the 30-minute candle, right at 10 o'clock. It was a beautiful opportunity for a call. Could have took it right to the 691, but I didn't.
Bryn makes great points on
So,
that, and I've been thinking about it.
No, I'm
recently,
just being
and
patient
I'll
right
just,
now.
Double click on what you said.
Probably about to wrap things up for the
Meta's
day.
Building and putting all that
Get ready for this
CapEx
storm.
into their own products right now. So versus a Microsoft spending similar amounts roughly that can leverage that cost eventually across their cloud as well as their own products. So they're also the tool belt, which I like. So it wouldn't surprise me. I know this is a way out there thought. It wouldn't surprise me if Meta one day goes into the cloud business. I mean, they've got the capital to do it, and we know there's a shortage of cloud capacity with all the AI. So, but this is a critical quarter for Meta. I actually
There's
think
the chart, right?
Yep.
That you see before you
Real good
exactly
advice.
when the earnings report
Don't give it back.
last happened, and that's exactly the slide that followed suit. Now,
the report was good, by the way. It was just the commentary which was not.
Now, when they've gotten a smackdown from either the market or a shareholder, Brad Gerstner, they've listened. They've listened. Will they take that to heart, so to speak, this time around and tell you something else about the amount of money that they're willing to spend so that the market can be soothed somewhat about the time frame for the return on all that invested capital?
And the answer is I think they will. I think they will, because he has done that. If you go back to when the stock's trading in the 30s and the issue was, do they have a mobile app or do they not? And they rose to the challenge. It had already been planned. So I think what he's going to do, he's not spending money recklessly. He doesn't do that. May seem that way.
What do you mean he doesn't do that?
In the market.
What do you mean he doesn't do that? That's the whole point that the stock, I think it was in 2023, had like his worst year ever because it was deemed that he was spending money recklessly on this metaverse and all that other nonsense that was away from the core of who they are. And that's why Brad Gerstner had to write the letter.
Right. And they're not doing that. I don't think they've done that since, because lesson learned. So I think it'd be very difficult. So I think that he will come out and talk to about it. He will come back and talk to an ROI on those spending dollars. But again, it's wildly out there. It wouldn't surprise me if they go into the cloud business. They should.
All right, Jimmy. Like I said, you can make the case for a lot of these names. Which one stands, out there with
Amazon.
all of the spotlights on? You think it's Amazon?
I do. And look, part of this is just pattern recognition. For the last more than a year, these stocks have not been moving monolithically. The so-called Mag 7 have not been moving together. We know that. And what we have seen with basically all of these names is that at unsynchronized times, they go into the doldrums and then they rally, right? We saw that, Scott, with Apple last year. After a long rally period, it just shot to the moon. We saw it with Google. I think Amazon is due. When I look at the valuation of the stock, yeah, it's a little bit pricier than the rest of them, but we know that's at least in part because they're sinking so much into their business development. Whether it's Amazon Web Services, whether it's logistics, I think that the valuation, if you adjusted for that, is a lot cheaper, and that's the one that I think money is going to start to flock to. I don't think that something like Microsoft is in the hurt locker, but I will be interested next week to see how it responds to earnings, and here's why, Scott. I would expect the earnings are great, but when we see a stock that is down year to date, I wonder if any pop on good earnings is used as an excuse for shareholders to actually take money out. I think that share price reaction to what I expect to be good earnings from Microsoft will be a big tell, and what I expect, Microsoft probably comes down even despite good earnings.
Microsoft has kind of been in the hurt locker. Can you pull that chart out a little longer to show?
It's down more than 15% from its high.
Exactly what we're talking about, either from the high or, I mean, that's not a really impressive chart. That says hurt locker to me.
I hear you. I hear you, and that's why, just to be clear, I think that they will have good earnings, Scott, but I do think that shareholders will be looking at that as a potential exit ramp. I wouldn't expect a pop.
The question is on Meta and Microsoft. Have they pulled forward a disappointment in the quarter? And the reason the stocks are up today is that they think the stocks have fully absorbed that news and moving up, is my guess.
It's good that we'll go to Kevin now because he owns all three of Meta, Apple, and Amazon. You own Microsoft too. So you've heard what everybody has to say. And now you can tell us what you think about who your own spotlight is on the brightest for next week.
Well, I will say that Amazon was my #1 pick this year, and I, like you, agree that these numbers should be very positive and constructive next week. So I don't think they have the most to prove. They had a horrible year last year in the light of all of the tech stocks rallying. I think the company that's really most under the microscope is Apple. You talked about 8 weeks of a downtrend, Scott, which is important, but the deal that they made with Google and Apple specifically for the AI, the pressure's on them for Siri, because if they can get that right, you have the ability to have another super cycle of sales, or maybe the first super cycle that's actually driven by AI. The support of the service business, we kind of know what we're going to get there, but I think everything boils down to what they say in guidance, how they talk about artificial intelligence and Siri, and if they don't get it right this time, I think they have more riding on a problem than anybody else.
I mean, we every time these earnings come around, we act like it's the Super Bowl is on the other side of what, when we say the week ahead, it's like this is the Super Bowl, and we always suggest that it's important. Do you think it holds more or less importance now that the group has underperformed? I could make the case before, and I probably did several times, that, well, because it was sort of like a monolith and it was almost holding up the market, that it mattered more than anything else. Like, these need to deliver now that you can't have one of the legs of the stool fall out. But if you look at the performance of the market now, the other legs of this market look pretty darn sturdy. So maybe they don't hold the same importance next week as they otherwise might.
To me, they do, only because of the weighting and how much of an impact these earnings have on the overall S&P 500. So if you have expectations that the S&P can deliver in excess of $300 a share, you need the big boys to come to the table and deliver, just like we'll need NVIDIA later in the month.
I'll take the other side. I mean, I think the numbers actually show that whether you're looking at the equal weight S&P 500 or small caps, that those sectors have rallied despite, as Scott's pointing out, the lackluster performance at best from the Mag 7. And this was a question a year or so ago. Could those stocks catch up with the rest of, with Mag 7 not performing? And I think the answer is in front of us is yes, the market can do well. Those other stocks can catch up even if Mag 7 doesn't perform as well. But I will say this one thing quickly.
Yeah.
You know, the one thing we're not talking about, because I think we all take it for granted, and I do, is that CapEx plans are going to be confirmed. There's no reason to think that they will disappoint on any CapEx plans, but that is the thing that if you wanted to worry me, one of these companies coming out and saying, maybe we've rethought this a little bit, and we're not going to build.
I don't know about that. We just made the whole case about Meta. Meta's the one that comes out and says, you know what, maybe we're going to try and be a little more targeted. We're not going to spend, the number's not going to be as large. I think maybe the market cheers that.
Honestly, that would worry me.
Why would it worry you? Because look what happened last quarter.
Because a lot of what I see in the other 493 stocks, in the equal weight, Scott, a lot of what I see is the what I'll call auxiliary sectors like industrials, materials, transportations, energy, that is going into building all this CapEx. Financials for financing all of these capital expenditures. If suddenly one of the key players says, maybe we're just going to tap the brakes here, I don't think the market will like that in the other 493 stocks that I'm talking about.
Bryn, why don't you weigh in? I mean, you do own the RSP, which is the equal weight, obviously. You don't have like real small cap exposure, which, by the way, the Russell 2000 has outperformed the S&P for the past 14 consecutive days. That's the longest streak since a 16-day stretch, all the way back to '96.
Yeah, I mean, small caps definitely, even with rates rising, albeit today, but small caps have done very well. We've chosen to play it with RSP. I also bought Apollo, KKR, other financials that are exposed. But I think it's important, just going back to tech for a second. If you look at tech earnings are looking to grow, like the Mag 7, around 26% this year. But if you actually break that down and you take NVIDIA and Broadcom out of that, Google, Meta, Amazon, and Apple, those companies together are looking to grow earnings about 13%. And so is 13% enough to get multiple expansion? And I think what's going to happen, especially with Meta and Amazon, is let's talk about margins. Because to your point, if they continue to do the CapEx and margins start to continue to come down, I think that's really where you have a multiple issue. Because one of the main reasons these companies have enjoyed incredible returns the last decade is the margin story. And to me, that's where you have to have CapEx spending, thoughtful CapEx spending, but also keep that margins. Otherwise, I think this market will continue to penalize these companies discreetly.
I feel like the committee, we have a run it hot investment committee, because that's the theme of what's worked in the market to start the year. The so-called run it hot stocks, energy, materials, industrials, a lot of cyclical plays, obviously. You're leaning in to that, Mr. Simpson. You have a new buy. It is Eagle Materials, EXP. Let's show the chart.
So this is a building manufacturing company, Scott. So from a material standpoint, we've had Home Depot for a long time. That's more, I think, residential. This is something where we're thinking about branching out into multifamily, commercial. It does have some residential for sure, but also when you think of the data centers, talking about concrete, there's so much in the way of the supply business that we like this. 17 times forward earnings, lots of free cash flow. I don't know that we're late to the party, because I think really to your point earlier about all these companies that are beneficiaries, AI adjacent, I think these material companies can really benefit from that spend.
Yeah. This is about a $7 billion market cap, a U.S. focused company. So, we'll watch that. There's another one too, Top Build Corp. Same theme?
This is the same theme. They focus more on insulation. Multiples a little bit higher. Very, very strong, from our opinion, just a very strong opportunity set in the building sector. I know these guys have exposure in some of the competitors. I like the space a lot, and we'll see what happens. If the build out over the next few years happens, the suppliers are going to be tremendous beneficiaries.
But you want to, these are statements in some respects of what's been happening in the market and what the outlook is for economic growth and the idea of a run-it-hot economy, a run-it-hot market, and playing into the broadening theme of the market overall, is it not?
I think it's even more important than you're stressing it, because this isn't our dividend strategy. This isn't our boring flagship old school portfolio. This is our growth strategy. And we're looking at names outside of the MAG 8, 9, or 10. We're going to talk about a few other buys today in the growth strategy that literally have nothing to do with the
Can I
tech side.
suggest QXO, which not only do you get that same element, but you get a consolidation story by a proven compounder that takes inefficiencies out of companies that he buys, as he did with XPO, with GXO, with United Rentals, and takes stock. Stock hit a new high, and I think it's continued to move.
Well, because the transports have been crushing it lately, which, you know, people like Ed Yardeni have been focused on is, you know, if you want to keep checking off bullish signal boxes, that plays right into that. What
That's
you want to say?
well, I just want to say, I mean, he said something pretty
exactly.
profound there, that a materials company like TopBuild or Eagle is in your growth strategy.
Yeah,
I mean, these are things that are normally found in value portfolios. I totally agree, by the way. I mean, it's not just the data center build out. If this administration's strategies come to pass, then we're going to see more factories built. You know, all of these factories need to have roads that go to them. They need sewer ducts, all these things that are built with concrete, with aggregates. Otherwise, this is a very boring sector. But when you get a growth spurt like this, and consider what lower interest rates mean in the context of government finance spending on all this stuff, infrastructure, factories that are built with tax breaks, I mean, this is going to be a growth industry if these strategies work.
Covered calls are the name of your game. You sold covered call on CAT. You sold a covered call on RTX. You want to tell me more about those?
I mean, CAT stays right with our theme, right with our AI adjacent. It was the #1 performer in the Dow last year. It's simply us looking to harvest some volatility that's surrounding a very hot sector. Pulled back a little bit since we wrote the call, so we look smart on it, but really it's just harvesting volatility. RTX specifically, you've got single stock risk when you have a president that's tweeting or posting about individual companies. When that happens, you see extra volatility around it. You can't buy back stock, you can't pay a dividend, you can't pay your CEO. Puts a little pressure around it. So we wrote a covered call on RTX. Love both of the positions. This is not a bearish call by any means, but way to make a little money.
It's been a tricky year in some respects for financials, hasn't it?
Yeah.
You know, they kick off earnings season. The stocks look pretty good going into that, and now they're pacing for the third negative week of the past 4. You can maybe hang on some headlines that have come out, obviously, some of the social media posts and some of the planned executive orders or the like that has weighed on names here, some of the credit card ones for obvious reasons. Bryn, speaking of, your new buy is Capital One. What's in your wallet? It's Capital One, right?
Yeah.
All right, well, this one is now.
It sure is. Yep. Yeah, so I actually took it was my final trade the day that President Trump announced that he would like to have 10% caps. And so I thought it was overdone. I've been listening to this call the last 3 quarters. Rich Fairbanks, the founder, CEO, love that. He's a total rock star. They did an acquisition that they announced today of this company called Brex that I wasn't familiar with, that really is on the enterprise side of putting together software, applications, all of this great stuff. I believe that Brex was valued around $12 billion back in 2022. They bought it for $5 billion. They are moving upscale to the consumer. They are moving into the enterprise, which Rich says this, you know, the enterprise say going against American Express is a $2 trillion industry. Brex is really important. I think it's a great company. I'll be buying more Monday. Let's let it settle in here. But if you want to look at a financial that, and also they talked about retail. Auto loans are good. So all this Tricolor and First Brands last year that we're talking about, that autos are doing terrible, their auto book is actually doing quite well. Their consumers doing well. So I think this is an overreaction today, and probably we look at it in 2 months and it's filled this gap that it's lost today.
Do you just not believe this 10% cap is going to happen in any way, shape, or form?
Well, I mean, just listening to Rich, he didn't mince words. He said it would cause a recession. You are hearing other companies saying, well, we'll issue a $1,000 card with a 10% cap. So we'll see if it goes somewhere, but I don't think we're going to have across the board. It just doesn't make any sense in our economy that you're going to have across the board a 10% percentage point cap. But there's definitely a non-zero risk that would happen. But I'm gonna go with a great founder CEO that's making strong acquisitions. They closed the Discover acquisition already. So I just think this is a neat company to own, to buy on weakness right here.
Okay, speaking of the financials, Kev, Bank of America is down 6% year to date. It's a new buy for you. Tell us more.
And again, this is in the growth portfolio, which is hard, sometimes hard to swallow when you get so caught up and wrapped up in the tech trade. But like so many companies this earnings season, when you post good numbers but have a little bit of a weaker guidance, you're seeing these stocks sell off. So this gave us an opportunity to own a financial name in the growth portfolio, playing into that breadth theme. We already own Goldman Sachs, JP Morgan, American Express, Visa. We're fully stacked in the dividend portfolio. But this is a member of the Russell 1000 Growth Index. They have Merrill Lynch, which we think is a true gem in the portfolio. They've gone through some problems, but the earnings number was really good. Low PE, single digits, price to sales 3.5%, 4%, solid dividend, lots and lots of free cash flow, and no lawsuit, at least not yet, by the president.
Yeah. Why do you think these names that got off to a good start and looked pretty darn good have struggled like they have?
Well, I think that's part of it, is that they're in the sights of Trump. And, you have to understand why the 10% cap isn't going to work, because the banks, when they take a look at their whole portfolio of credit card holders, having 10% doesn't compensate them for the risk of the credit card holders that don't have the good FICO score.
Is it even worth talking about stuff? I mean, honestly, that the chances of it happening are slim and none, and Slim just left?
I don't think so. I agree with you.
You know what I'm saying?
I agree with you, but they're reflecting right now. They moved up. I think the quarters were universally pretty good. JP Morgan, there was some criticism, but I thought it was a great quarter. I think it's just a sell-off, basically, on profit taking. For what reason, I don't know. But, you didn't have all of them report great numbers. And it's always the lowest, water finds its lowest level in earnings situations, and that's bringing them down.
I usually like to try and bring things full circle by the end of the A block from where we started, with a theme that plays into that. And I think we'll do that with looking internationally for a moment and noting that the emerging markets hit a record high on Thursday. In a week in which Sell America has been a topic again. People look at what's happening because of the rhetoric around Europe and Greenland, whether that is going to be a thing, whether it's durable or not remains to be seen. However, nonetheless, there's a story out from Reuters: big North European investors reassess U.S. exposure. It's worth noting, by the way, that the Nordic region is home to some of Europe's biggest pension funds by assets. So there's the idea of selling treasuries, right? That's one thing. Jonathan Krinsky of BTIG talks about losing prestige worldwide, what that could mean if it's some sort of durable trend. Last year, international markets outperformed the U.S. by the widest margin in however many years it was. How do we think, Jimmy, about this?
Quiet Soul said he in Scrooge McDuck mode. That he ain't giving back not a ting, not one more ting. I got you guys, no doubt. Poetic justice. That's what it is. Let's wrap this week up strong. I'm really not interested.
That we've had for the past several years. That's our way of saying that, okay, there are the forces that you're talking about, Scott, but those forces have been talked about for quite some time now. And if we look at actual capital flows, they don't show a mass exodus out of U.S. markets. And in particular for U.S. stocks, it shows inflows. Treasuries, little questionable.
Okay, but that's sort of apples and oranges to the broader picture. Yes, it's important to talk about the flow of capital potentially moving out of the U.S., which seems unlikely.
Right.
Biggest, deepest markets, et cetera, et cetera. But the performance is another thing. Brazil up 10% this year. China up 8.5%. Japan up 7%. Mexico 6.5%. Canada 4.5%. Hong Kong 4.5%. London 2%. The DAX up 1.5%, and the S&P at the bottom of the barrel. up one. That's part of the point.
Right. So if you're going to overweight these sectors, again, we're at a neutral weight. But if you're going to overweight them, you're kind of buying into what Mark Carney said. I'm not saying he's wrong, but I do think it's premature to make this bet. Mark Carney said that basically the U.S.-led world order is not just undergoing transition, but it's permanently rupturing. And you can see that in things like the European Union having a trade deal over the last couple of weeks signed after many years of negotiation with South American countries. I right now, and we as a firm, don't think that the U.S.-led economy is actually going to rupture permanently. There are some threats right now, but we're not willing to change our investment stance in terms of that being a permanent rupture.
Okay, so
look, real quick. Defense budgets also drive economies. And to the extent they bring more of their defense budget spending overseas and spend more, that'll help drive their economies as well.
So let's squeeze in a break. We come back. You know the story by now. Gold and silver, new record highs yet again. Halftime committee member Bill Baruch, he's making some new moves around those, and he will join us next. And he will reveal exactly what he is doing. All right, welcome back. Silver topping $100 for the very first time ever. 5% today. Gold hitting a record high yet again. Predictions are 5,000 could be hit anytime.
Right
and
there.
Well beyond. We're right there, obviously. Yeah. It's kind of the master of the obvious, right?
Yeah, well, I
took a trick out of your book.
I was doing that for Kevin.
Yeah. Bill Baruch, we said he's making some moves in the space. He joins us now to talk to us about this. Which is interesting. I guess you're looking. Nice to have you. Are you looking for this to top out because you're selling the physical gold and silver trust?
So I'm not looking for this to top out. I've been waiting for this to happen for 10 to 15 years as somebody that cut their teeth trading gold and silver back in 07 and 08. Here's the thing. We own CEF. We did own it, but you go back 3-4 years ago, this made up about 20% of the Sprott physical gold and silver, or the silver made up about 20%. At the end of 2024, it made up 30%. It is now 45%. Silver is now 45% of this ETF. And you look at the silver gold ratio, it's dropped down to, or gold silver ratio has dropped down to some support, meaning gold can outperform silver. Now we've hit this big, massive benchmark at $100. And, I have wrote in my investor letter earlier this year from our commodity fund that I think 5,000 gold and $130 silver could merely be the middle innings. But the way we're looking at this in portfolios right now is I want to sell CEF and I want to move that money, swapping it out for OUNZ, which is straight gold. Because I want to just see here if gold does outperform, and I want to take that risk off the table in our wealth portfolios at the moment, monetizing that. Because if you think about it as well, CEF has outperformed GLD and OUNZ by 40% over the last year.
Good stuff. I appreciate you joining us, documenting that trade, Bill. We'll talk to you soon. Weiss, you own the GLD. What do you make of this remarkable run? Is it more durable than it's been? You tell me. I don't know.
Yeah, well, first of all, Bill's done a great job on it, and he was in it long before I was. I think it does still have some legs. As long as we have, geopolitical instability, this is a place where someone can go to hide. And then you picked up the momentum players in this trade as well. So everybody wants to see 5,000. I hope it doesn't turn into Bitcoin 125 when that was the top, and then it just kept falling back. And to me, that's a very real risk, because while there is some tangible value to gold, it's not reflected in the gold price. There's a little fluff in there because we just don't know how to really value it, because it's a safe haven and it doesn't trade on intrinsic value. So the bottom line is, I think it goes through 5, but it could very well fall back from there.
I'd rather play the miners, Scott. Gold's a great commodity for sure. I think there's no comparison to Bitcoin, but when we're looking at AEM, which is a stock,
that I was talking about.
I don't think so. When we have there's a use case for gold. I don't know that there's a use case for Bitcoin. I learned that from you, so that wasn't an insult. But the AEM, the Agnico Eagle, which we own, is up over 130% last calendar year, 52-week high today. You get a dividend, strong dividend growth, great margins, and when labor and energy is cheap, the efficiency is even greater.
You all blinged out on the weekend? Is that when you put
a gold
is that when you put your gold on? That's when you get your gold on?
I've got a golden shovel.
Yeah, I'm sure you do. I'm sure.
For all the stuff he talks about, that's the shovel.
All right. We get serious for a moment.
Yeah.
Because we do have a developing story. A major winter storm that is bearing down on a large portion of the U.S. this weekend. AccuWeather's Bernie Rayno joins us now with the latest. Hi, Bernie.
Yeah, hi, Scott. You're exactly right. In fact, the biggest snow and ice storm for many AccuWeather saying in nearly 5 years. 200 million are going to be impacted by this storm, and travel, we believe, will be shut down, airways shut down across the country Sunday into Monday, and there could be lingering impacts until Wednesday. Here's why. A large area of freezing rain that's going to knock off power for over hundreds of thousands of people, or thousands of people without power. Heavy snow from the southern plains toward the northeast. And oh, by the way, widespread cold air that could tax the power grid across the country this weekend, including into Texas. Let me show you the ice. That's going to be extensive. Look at that dark purple, or pinks, I should say. Dallas, Shreveport, and into the Carolinas. Huntsville, Tuscaloosa on west. It's Saturday night. East of that line, it's Saturday night into Sunday. The snow is going to be extensive, a large area of 6 to 12 inches Saturday night. Wichita, Kansas, Oklahoma City towards St. Louis, and then we zone in on the Mid-Atlantic and Northeast Saturday night into Sunday. Note that dark blue shading where we're looking at over a foot of snow and an AccuWeather local storm max of 2 feet within that dark area. Boston around a foot of snow. New York City could see a foot. And there could be a foot in New York from Philadelphia toward Washington, D.C., Scott. Huge storm, impactful storm on the way.
All right, we're going to be waiting for it. Bernie, thank you. Appreciate that. Coming up, we do have more committee moves to get to. Kevin Simpson has yet another one. It's another new buy, too, so you don't want to miss that. Plus our calls of the day. We're back in 2. So Intel is, if there's a stock of the day, I guess this is it. It's down 16.5%. That's the lows of the day on the week outlook. Kevin, you own it. You know, this story is, I guess, complicated by the fundamentals versus the backstop, okay? Declining fundamentals versus a government backstop, which is why the stock before this move was like the best performing chip name year to date by a lot. I mean, it was like parabolic. If you look at, can we show a year to date on this? Look at that. So how do you assess it knowing that you still have, I believe, or at least the people who are bearish this name, fundamentals that are questioned versus the fact that the government is in it?
Yeah, I wish we were talking about it yesterday. It would have looked a lot smarter. We bought this about a month ago at $42 a share.
Wow, no, you might have been talking it up yesterday and then it would have gone down like this. You look like an idiot.
Yeah, either way, I look like an idiot with this one. I don't think there's a win. Yeah. So I'll tell you, with this stock, I trade like a meme stock. It's a classic sell the news event here in a very, very big way. We looked at this really as something that was a complement to the AMDs, the Avago, Broadcoms, the NVIDIA. It's a small position in the growth portfolio, new position, ran up way too hot, way too fast. The numbers were good, the guidance was bad. It's a demand story. They have demand, they don't have supply, so maybe that works out. But what I don't like is the single-digit growth expectation. So if you're an investor in Intel and you're thinking about it as a 2027 story, maybe you're in it. If you're looking for a short-term trade or a snapback, you're going to need a tweet or some kind of memification to get it to move. So I would not follow me into this on weakness.
Okay. Let's get another move from you. It's Medtronic.
Yeah, we have it.
Healthcare is the second best sector over the past 6 months, but obviously that's sort of cooled off by a lot. Oh, what's up with this one?
We haven't owned this in probably close to a decade, Scott, but this is a story of improving margins, very good dividend, lots of free cash flow, 16 times forward multiple. But the real reason that I want to be in this name is because of the demographic. You think about who's the potential customer base. And this is a baby boomer market where more of us, not all of us at the desk, but a lot of us age every day. We get closer to needing some of these things.
You speak for yourself, but that's okay.
I get older every day, and Medtronic is a stock that has cutting edge. We also own Intuitive Surgical, which we'll talk about later, but it's the same theme. Tons and tons of potential customers and lots of profit. So $5 billion annually, and I expect that to go up. As a side note, they've increased their dividend for 48 years in a row. So not quite a dividend king, but almost there. Okay, let's look at Disney. There's a regulatory filing that they have reiterated their plans to name a successor to Bob Iger in early 26. Early 26 in quotes. Jimmy?
I feel like we're in early 2026.
Right, wow.
Right?
That means it could come at any time.
Yeah, I mean, and it really should. It's one of these things like, I don't know if it's like Trump with selecting the next Fed chair, but it's like, don't we kind of know who it is? Like, let's just get it out there. This is an unnecessary overhang in my opinion. I'd like to see this announced. And then we just focus on the fundamentals of we've got a run at hot economy. We've got low unemployment at 4.4%. Let's get people on those Disney cruise ships. Let's get people in the movie theaters, which frankly they are doing. So let's focus on that, not the CEO turnover.
Okay. Let's do SLB, because they beat and they raised their dividend too, which is in your wheelhouse, Kevin, which you own that name.
Yeah, and this is a relatively new name for us, Scott. We didn't get into it because of anything happening in Venezuela, but certainly the stock moved a lot higher after the fact. It's given a lot of that back, but we like it because of the expectation for energy. In 2022, we had Chevron, ConocoPhillips, and Marathon Petroleum. They worked really, really well. We got away from the trade, and we're bringing and introducing energy names back into the strategy this year.
All right, let's take a break. We got Santoli on the other side with his midday word. we're back. Our senior markets commentator and overtime co-anchor Mike Santoli is here for his midday word. It's been obviously a turbulent week, and we have a lot in caps, all caps, that lies ahead.
It's true, and you can see the market kind of maneuvering ahead of that in terms of the tech earnings in particular. But, you know, yesterday at this time, Scott, I was saying the one thing that kind of was bothering me was how happy everybody was with the nature of this broadening out and the cyclical leadership, and the trade that everyone thought should work is actually working. You can't find anybody who doesn't like banks and all the rest of it. Well, today you're seeing a total counter trend move. Banks down 2.5%. Software's bouncing just when nobody thought it could bounce. Microsoft's the biggest upside contributor. I don't see it as necessarily a trend change, but it's one of those things that's going to test the conviction of people who said, hey, this is exactly how it should work. We should be owning industrials and banks and everything else. Other erratic action I would point to as well. There was just a huge jump in the yen versus the dollar. People thinking maybe it's intervention. Who knows? But it just shows you there's just a little bit of these sort of spring-loaded moves out there. You look at what's happening in silver and gold. And so that part of the macro market hasn't really calmed down, even though yields are fine. They're above 4.2 on the 10s, but, you know, not far. So I just think we put all those things, you know, on the screens and make sure we're alert to the fact that, you know, even though we bounced off those lows a couple days ago, to me, it wasn't just about, you know, Greenland crisis or no Greenland crisis, because the overall market has remained a little bit kind of stuck and just in the throes of these cross currents.
I feel like Fed risk is pretty much off the table because the market doesn't expect anything.
Doesn't expect it, doesn't feel it needs it. I think that's the bottom line, because everyone still feels like we have a little bit of fiscal firepower coming. Economy's going to be supported, and, you know, we're looking at, you know, 2 cuts for the rest of the year. Any one meeting doesn't have huge stakes in that regard.
All right, I'll see you on the CB. I look forward to that. It's Mike Santoli coming up. We'll give you the setup. All right, the setup. Bryn, I want to come back to you on Tesla for a moment. It reports on Wednesday. You already said you're not really expecting great things. I should note, too, the stock has underperformed the S&P 500 by 20 percentage points and the NASDAQ by 50 over the past 5 years. Now you have the Wall Street Journal out today in a report that says Musk is diving back into U.S. politics. That's their headline. Just when investors thought that he had maybe put that in the rear view, pardon the pun, and had decided to focus more on the issues that matter most to you. You hear this headline, you see the stock performance, you think what?
Well, I think from the fundamentals, which are earnings, that earnings are expected to be down 38%. So not going in the right direction, as I said earlier. I think I've done a great job trading this stock because I continue to sell calls. Right now I have 500 calls that expire February 20th, and I feel there's a very low probability that those get called away. And so I'll take advantage of those political opportunities if that lends itself. When he announced the American Party, the stock was down, I don't know, 15%. I bought more. I'll sell calls again. And so I think this is one of those names that if you just own the stock and you time it right, time it wrong, you're right. But if you own the stock, add to it when you have these events and sell calls, you can have a really wonderful total return. So I'll just continue to do that because I do think this is like one of the great disruptive companies, and I'm a big fan of the innovation and the people that he has around himself at Tesla, SpaceX, et cetera.
Okay. IBM's Wednesday also, Kev. You own that name?
Yeah, we didn't talk about this as one of the Mag 7 stocks, but quietly it's up, I don't know, almost 30% in the past 12 months. The numbers were good last quarter. They should be good this quarter. What to watch for? Consulting services. We would like to see that stabilize.
You want to take Altria, which is Thursday?
Yeah, I don't have any high expectations there either. Kind of weak off the last quarter. You just want to see them maintain the cash flow to support the dividend. There's not much more to that story.
Verizon next Friday?
Even a more extreme version of just hoping that they can make enough money to pay the dividend. I wouldn't be buying either one of those before the print.
Wow, you don't sound excited about either.
I've hated Verizon for 7 years. We've owned it for 7 years. It's
just
a
for the dividend?
play. Yeah, we have to have an allocation to a telecom. So for many years, it was either Verizon or AT&T. At this point, maybe T-Mobile is even a better one to take a look at. But we've owned it. It hasn't done anything in years, but it pays us 7%.
Exxon and Chevron are next Friday. Jimmy, you have Exxon.
Yeah, and I think the thing here is that we are actually starting to see some upward pressure, not just on crude oil, but natural gas. And that's going to flow through to a diversified company like ExxonMobil. You got good refining margins, transportation, distribution, et cetera.
All right, we'll do finals next.
أشرقت نفسي بنور من فوق
Closing bell, 3 o'clock Eastern. We'll have an interesting last hour, I can guarantee you that, because we'll speak with Tom Lee, and Keith Lerner, Malcolm Etheridge, Jeff DeGraff, and Lo Tony as we look ahead to those mega cap earnings, which are looming large next week. Bryn, your final trade is what?
We're going to stick with Capital One. Very integrated, vertically integrated. They own the rails with Discover. They're the issuer, and now they have B2B with Brex. I think it goes to 250 in the next year.
Okay, Mr. Gold.
Medtronic, it's a new position for us. Surgical, innovative pioneer, tons of free cash flow and improving margins.
You gonna go watch like Austin Powers or something this weekend? You feel good about yourself? Farmer Jim.
Transocean, $700 billion of free cash flow projected this year against a $5 billion market cap. You do the math.
Okay.
Caterpillar, I mean, even it's down 3.5% today. It's not a big sell-off in the context of what it's done, but I'd buy it here.
All right. I'll see you for that final stretch. As we said, 3 o'clock on closing bell. The exchange begins now.
Scott, thank you very much. It's a make or break for OpenAI, a crucial moment as well for the Mag 7 trade, and the latest on that massive storm threatening nearly half the country. Welcome to the exchange. I'm Kelly Evans. Stocks are actually on track for their third negative week in 4, despite, or in some ways because of today's price action. Only the Nasdaq is positive right now. The Dow's down 390. The small caps are down almost 2%, maybe harvesting some gains. Even with this move, they're still in the green for the week. Now, as for the tech trade, kind of a mixed bag today. As mentioned, though, it is one of the brighter spots of the market. NVIDIA shares up 1% as Jensen Huang is reportedly traveling to China next week, with the country evidently telling its top tech firms to prep their H200 chip orders. And take a look at Microsoft, another standout, up nearly 4% today, on pace for its best day in nearly 6 months. Now, as you've heard, shares of Intel are heading the other direction, falling sharply on soft guidance. They're down 17% now as they just keep sinking throughout the session today. Again, after a huge run-up into earnings and over the past several months. But let's begin with the shifting narrative around AI, which has been reshuffling the Mag 7 and AI trades. The biggest concerns center around OpenAI and the companies in its ecosystem. This morning, Deutsche Bank warns that OpenAI is particularly extended and maybe most at risk, as it doesn't seem to have found a workable business model yet to cover its reported cash burn. That cash burn was $9 billion last year and is likely $17 billion this year. Sebastian Mallaby taking it a step further in a recent New York Times article, predicting that OpenAI will run out of money in the next 18 months. And Google shares have far outperformed OpenAI names like Microsoft and Oracle, at least until today. So is the reshuffling since Gemini's launch over, or is there more still to come? Let's bring in Deutsche Bank's Adrian Cox, who wrote that note on OpenAI today. And Adrian, not to be too myopic about the action today, but our investors, now they've digested this massive reset over the past few months since Gemini's launch, has that cleared the way actually for, for some maybe better data points? Or do you think this is so existential for OpenAI, it's going to be really hard for them?
Well, I think you're right. This is actually, in a way, going to be a year of disillusion, not only for OpenAI, but for the rest of the AI trade. And that isn't necessarily a bad thing. It's probably a good thing that as any technology is becoming applied in real life, then you begin to really understand what are the strengths of it and where the challenges lie. For OpenAI, I think you're really seeing the problems that you have when you're a company which absolutely had the field to itself for the first couple of years, but then began to be followed up by other companies producing similar, or in some cases superior models. And if you're Google, for example, then you have the advantage of massive distribution already, a huge audience of users using your product absolutely every single day, not needing to go into a special app for it. You also have enormous data that you're gathering every time you do a search. And on top of that, and possibly the most important thing, you have enormous capacity with data centers, which you're investing in tens of billions of dollars every year. And this is also the case with the other hyperscalers. So unlike them, OpenAI has to go out and raise funding for all of the training that it's doing in data centers, which presents it with a real challenge. And so you can see why it is having to look around for different business models.
Yeah.
It has 800 million weekly users, but its subscriptions are only a small part of that. And in fact, Deutsche Bank data that we've gathered in Europe shows that those subscriptions have more or less flatlined since the middle of last year. So they have to find some other way generating revenue.
And they seem to be kind of casting around for those ways. Slow Ventures general partner Sam Lessin is also with us. Sam, welcome to the conversation. And how would you spin this narrative forward? I'm curious if I'm sure everyone is talking about this, right? The way that OpenAI is pivoting to find other kinds of business models and levers it can pull. I think the broadly more interesting point is that the Mag 7 used to all have their lovely little moats. You know, Yardeni Research talked about this. You know, Apple had the handset and Google had search and, you know, Meta was, and now AI, they're all at each other's throats and introducing ChatGPT as a competitor as well. So do you see it that way, that the gains of one come at the expense of another?
Well, I think you have to break out, you know, what AI is and kind of where we are. I'd say remember, OpenAI today is what I call like a narrative asset, right? It's a story. It's a great story, but it's a story where the vision has far outpaced reality, right? And if you kind of unwind a few years, we were talking about whoever gets to AGI first is the ultimately winner, full stop. It turns out that actually no, like people can catch up, the model competition isn't over, lots of different takes. You know, my personal view is that actually AI is great for all the incumbents. It's great for Google, it's great for Meta. They don't have to compete long term. They actually have distinct business models, all of which are levered by AI. The interesting battleground is kind of the new surface, or the net new, where there is kind of a feeding frenzy of who can try to win. OpenAI is they're seriously outgunned from a distribution perspective in most other areas, but they did for a while own the narrative. The question this year is, can they continue to own a narrative? And how much will the market and the world support that narrative as actual evidence piles up about the viability of businesses?
Look at what's happened in the market since you could go back to last summer, but especially since November. Most of these, Oracle is down like $500 million in market cap since September. Microsoft has shed, I think, $600 billion in market cap since last summer. I mean, these are two of the names that were most levered to the rise of OpenAI. And here comes Google, which was the Mag 7 name that by far has done the best over the past year. It's up like 70%. And it doesn't even need NVIDIA's chips in order to do this. So I guess that's my point. And you're right, maybe AI just is a sheen that helps all of them. But right now, there certainly seems to be Gemini's rise is coming at the expense of the valuations of a lot of those involved with ChatGPT.
Well, I will agree with that. But I think for me, I think the thing to keep in mind is my narrative on AI has always been the incumbents win, right? And the OpenAI trade was, no, actually, this is so disruptive, the incumbents won't win. And ChatGPT will be able to take down Google, and there's going to be a whole new economy. I just don't buy that. I never have. I think what you're going to see is that this is not, AI is an extending innovation. That means Google crushes it if they get their stuff in line, which they are. That means people like Meta crush it because their ads model is perfectly aligned with AI. And everything else is going to be a slog and a battle, right? There will be some winners out of this. It's not like nothing will change at all. But, you know, I think what we're seeing right now is reality kind of coming in and people starting to look at reality versus the narrative story of AGI is coming in. Whoever gets there first is the ultimate winner and everyone else goes to zero.
What I like about what you're saying, and Adrian, I'll put it back to you. This is what, as people have been messaging me, the quote unquote smart money is with Sam on this one into next week, meaning now that we've had this massive valuation reset from Gemini and away from ChatGPT, is earnings next week, Adrian, a chance for the Mag 7 to prove, you know, look at Apple's struggles and all that they still have a good story to tell, and that in the long run, AI is still additive, enhancing, whatever you want to say for them. You know, the expectations have certainly been pulled in for everyone except maybe Google for next week.
Yeah, I think that's right. I mean, there has been, as I say, a certain disillusionment. I think that people are also coming to terms with the dislocation in the markets, which means that even though there is massive demand out there, there is also a whole host of supply constraints that are only now beginning to emerge, whether that's HBM memory, or whether it's energy, or whether it's capacity with talent just to build data centers. So that is one issue, and then also there's just an issue of distrust as well, which the entire market is going to have to grapple with, because however successful you are, if there begins, and Sam's been talking very compellingly about narratives here, if the narrative begins to go against AI, then there is always the chance that politics can get involved, not just geopolitics, but just domestic politics, and put the brakes on some of the developments that can happen, whether you're a hyperscaler or whether you're OpenAI.
Well, I certainly think, Sam, if this becomes too much of the narrative, people are already mad that Google's winning. They're like, come on, we've been fighting, antitrust, where are you? They're monopolistic. They don't like the idea that the winner, Google had the biggest market cap of the Mag 7 in 2015. They were still FANG in Cramer's lexicon back then. And in 2025, they're back to having almost the biggest market cap again. So it might feel unfair and it might generate pushback. But again, I just want to kind of bring this to kind of the trading point of view, which is, Sam, then do you think people will ultimately say, yeah, you can own the Mag 7 trade? It's going to be, because this has been one of the biggest debates in the market. And it sounds like you're taking the side of kind of stick with that trade. It's going to be fine.
I mean, that's been my talking point for 2 years, right? And the reality is, because the narrative around winner take all, AGI race has been so strong, it's been a very compelling narrative to a lot of people. You've seen this dislocation where a lot of strange things have happened based on theory, not reality. I think as people start being sober and thinking about profitability and growth and kind of who owns what lanes, you're going to see things shift back towards the Mag 7 narrative. And then, look, there'll be some weird things that happen on the side. Like, it's not like nothing will change. And I do think AI is important. I don't think regulation's stopping this train. The question is just who gets rich off of it and who grows off of it. And I just don't, there are games that are disruptive to the incumbents. AI is actually not one of those games.
Yeah, no, in this case, that does appear. I mean, look at, with the Gemini thing, you want to cheer for the underdog, they're not.
I just don't know that I don't know that. I think the interesting thing with OpenAI is they set themselves up narrative-wise, right? Just all storytelling as not the underdog, right? So they don't have the benefit of being like an underdog player in a lot of ways. But at the same time, like, they tried to, I think they've been on a trajectory of trying to get too big to fail. Which is, again, it's a strategy. It's just not necessarily a strategy that is going to kind of topple the world order and effectively get the most leverage from AI.
Yeah, well said. Gentlemen, thanks. We'll leave it there for now today. Appreciate it. Sam Lessin, Adrian Cox on some of this rotation we've been seeing. And we'll get the Mag 7 and the memory stocks in next week's results. Perfect timing to kind of shed some light on this. Meta, Microsoft, Apple, SanDisk, Western Digital, they're all on deck. The memory names have been outperforming the Mag 7 by about 6 points this week. So which group is the better buy? Let's ask Victoria Green, G Squared Private Wealth CIO and a CNBC contributor. Victoria, let's start with Apple, which wasn't part of that conversation, but has been down for 8 weeks in a row. Some of these high memory prices and others could hurt them down the road this year as consumers bulk. What do you do with the shares here?
I actually still like Apple a ton. I think it's a great tech and AI play without getting into the hyperscalers and massive debt load. And I think they sold a ton of phones in Q4. And so we're looking at that. Their services growth, their phones growth, they can continue to increase prices. I think that's a very elastic thing that they continue to do. I mean, we all know what the iPhone 17 Pro sells for. And so that's going to continue to drive margins and kind of offset the memory chip price increase. Yes, we're aware. I think the memory is going to get a little bit more expensive, but I think Apple's going to do a very good job of offsetting that, as well as their services continue to become more and more important. Their wearables are more important. Yes, it's still all about the all-important iPhone, but it's a well-diversified company, and I love what they're doing with Google.
Yeah.
If you can't build it well, buy it, and they finally acknowledge that Siri is falling well behind. They had a bad AI strategy. They ripped the Band-Aid off, and I'm really excited about what they might do in 26.
Again, speaking of the incumbents winning in AI, these were literally the two that owned the search on the iPhone trade of the past decade, and now they're going to own Siri on the iPhone as well. We'll circle back to the memory names, but quickly on Microsoft. It's been down 10% in the past 3 months, but showing some life today. What do you do with this one?
Yeah, I've been trimming it, and it's a sell, and I'm sitting out. If you don't own it, I'm not sure I'd buy it pre-earnings. I'm very concerned about Azure growth being crimped because of the supply constraints. So it's not necessarily demand. I think they're still going to have massive hyperscaler demand because of their deals with Anthropic and OpenAI, but the supply constraint is a really big thing for them, and their CapEx may continue to expand and explode because of those huge deals, right? So you have these massive deals. You have to do these huge build-outs. That's going to hurt CapEx, and if there's one thing investors are getting very tired of right now is increased CapEx drag on these stocks. So for me, if you don't own it, I might sit it out. If you own it, we've been trimming it back a little bit, taking some profits.
And you think with Meta, which also reports that if they walk back on CapEx, then you would be a buyer?
Oh, absolutely. I'm hoping Zuckerberg sees the light here. And we've had some good news coming out of that, right? Reality Labs got cut back 10%. We're thinking if they're a little more reasonable on CapEx, Meta's a wonderful stock. And so, but it's all going to come down to what is that CapEx number? Because if he comes out being like it's still an AI arms race, they come out above expectations, I think the stock's just going to get hurt. We're a hold here on Meta. I think it's quality name. They dominate the ads and social media, likely driving higher ad prices because of the targeted social media, but Llama's fallen behind. So they also have that. They're losing a little bit of ground for pure play AI search because Llama's really not doing what Gemini and everybody else is.
Yeah, we heard a bull case for that earlier this week from Brent Thill. He thinks maybe on the enterprise side it'll make some more inroads. But what about the memory names? SanDisk and Micron report, are they at risk of getting Intel'd?
We're getting Intel. They are, but for me, I'm bullish on these right now because if you look at all of their spending, I think you're going to see that the hardware constraints are what's going to continue to drive pricing here. And I think a lot of them have great transparency. They're in huge demand. The data center build out, I know there's some narrative that that's slowing down, but there's still a huge ramp up for them. And I think it's like Western Digital sells about 80% of their revenues to the hyperscalers. And so for me, I say this is a very secure revenue source. They're still building out, even if AI is this narrative and it's maybe going to have some headwinds, the build out is there and it goes in everything. It's in the servers, it's in your smartphones, it's in your computers, everything we're touching, everything that's getting upgraded. If you look at it and say, I don't really love the software trade, the hardware trade, these new names might be where you want to be. And they're kind of running a little bit more than the chips and the semis. Maybe you want to look a little more at memory.
Hardware is the new software. That is the headline. What a sea change that is. Victoria, thanks as always. Appreciate it.
Thanks, Kelly.
Victoria Green with G Squared. Western Digital CEO Irving Tan will also be joining us exclusively on the exchange next week to discuss these quarterly results. We'll talk about AI expansion and what it all means for some of the shortages we're experiencing, again, next Friday at 1 p.m. Coming up, 200 million Americans across more than a dozen states are preparing for a massive winter storm. Alaska Air CEO Ben Minicucci joins us exclusively with some of his thoughts. Their shares, by the way, are up 6% today on strong earnings. Plus, our market guest says fight the FOMO and focus on value. What does that mean for semis and for software names we were just describing? We'll look at the growing divide within tech stocks ahead.
This is The Exchange on CNBC.
Natural gas prices, which are famously volatile, are still set to see their biggest weekly gain on record, spiking 70% pretty much since Monday, as half the country prepares for a massive snow and ice storm that's set to hit this weekend. AccuWeather's Bernie Rayno is here with the latest. And, feel free to dwell overly on kind of northern New Jersey, Bernie, and giving your report. Welcome.
Solid 6 to 12 inches, northern New Jersey, Kelly. Some spots, I think, will get over a foot, and even New York City has the potential of a foot. But as far as the Northeast, just part of the large area this storm is going to impact. 200 million impacted, and AccuWeather believes air travel will be completely shut down Sunday into Monday, with the lingering impacts in the middle part of the week because of this. Freezing rain, hundreds of thousands may be left in the dark for days, if not weeks, across the southern tier of the United States, and the heavy snow from the southern plains all the way toward the Northeast. In fact, this will be the biggest ice and snowstorm that many have seen in about 5 years. And then you have the cold, widespread and intense. Just take a look at high temperatures tomorrow. These areas in the pinks and purples barely above zero, and it's a large part of the country, big enough that this could compromise the power grid across the country, including in Texas, and they made all those advances since 2021. Let's talk about the ice. It begins tonight and it continues into tomorrow across Texas and all the way into the Mid-South, where you see that dark pink shading, Dallas toward Shreveport. The icing could be extensive. Then Saturday night into Sunday, it goes across the Mid-Atlantic and includes the Carolinas, Raleigh, Charlotte, toward Columbia, and Atlanta. You could have almost 1/4 inch of ice, and that will shut down travel there as well. The snow, widespread. We begin Saturday and the Saturday night in the southern plains, and this is going to impact I-35, I-40, 6 to 12 inches, Wichita, Oklahoma City, toward Kentucky, and in the northern parts of Tennessee, 3 to 6 inches, including Nashville. That'll be Saturday night. And then Saturday night into Sunday across the Mid-Atlantic and Northeast, this dark blue shading is where we believe there's 12 to 18 inches. We have an AccuWeather local storm max of 30 inches. Within this blue area, south central Pennsylvania, in the parts of New England, we could easily see over 2 feet of snow. Some specific snow totals for you. Washington, D.C., Baltimore, Philadelphia, 6 to 10 inches. Heavy snow going over to sleet, but it could be all snow. If it is, it could be a foot. We could see a foot in New York City, Boston as well. And by the way, snowfall totals, 1 to 2 inches per hour. That's going to cause major problems on all the roadways.
We appreciate that, Bernie. I'm hoping it's more powdery than icy. Got to get people out there playing in the snow. But we're about to speak with Alaska Airlines CEO, so we'll talk to him about this. Thank you, Bernie. Bernie Rayno, we appreciate it. For more on the travel implications, let's bring in the CEO of Alaska Air, Ben Minicucci. Also on the heels of their earnings, has the shares up nicely today. He joins us alongside Phil LeBeau. Welcome to both of you. Phil, kick it off.
Thank you, Kelly. Ben, you had your earnings after the bell yesterday. You beat the street. But your guidance for 2026, you set it at a pretty wide parameter, I think, between $3.50 and $6.50 a share. What's your outlook in terms of demand in the first quarter and then for the rest of the year?
Hey, good to be with you, Phil and Kelly. Yeah, you know what, Phil, for 26, we did have a wider range, and that's just based on the experience we saw in 2025 with the macroeconomic volatility. We had a lot of fuel volatility here on the West Coast. So the range really captures the possibility of some of that volatility that we could see. Right now, we're getting to the middle of the range around $5, and just coming out of gate in 2026, just like everyone else, we're seeing really strong bookings, super strong bookings. In fact, record bookings in our history. So we feel pretty good so far starting 2026, but we have that cautious optimism about things that could happen that drive the volatility that we saw in 25.
Ben, you mentioned the volatility when it comes to the jet fuel that you get on the West Coast. They've had refinery issues out there, so it's more expensive than, let's say, if you were fueling up in other parts of the country. Do you expect that to drag out into the spring?
Gosh, I hope not, Phil. We've seen it now for at least almost 2 years, and the key root issue is in California, the refinery factories not staying online and driving fuel prices up, and not just for flyers, but for people all across the West Coast. It's an issue. We got to keep these refineries working for the industry and for Americans. And And so I hope it stabilizes, but that is a big risk for us going forward, for West Coast fuel. And Phil, just like a little number is 10 cents per gallon of fuel, higher than everyone else, represents 75 cents of EPS. And that's the reason for our expanded range.
What about the IT issues that you saw in the fourth quarter? You're obviously making the investment to avoid those in the future. Will that investment, how long do you expect that to stretch out over the next couple of years?
You know, Phil, the way we think about that, and those IT outages were painful for our guests, our financial results, and our employees. But the way we think about those investments are short-term investments. You know, we had experts come in, and it wasn't so much for a lack of investment, but where the investment was being made and how we were configuring our hardware and our infrastructure. So we're making those investments right now. Some of them are already in place. More is coming on short-term hardware configuring infrastructure investments. Longer term, whether we move into the cloud, that's more of a longer term investment that we're working on. That decision will happen towards the back half of the year. But so far, you know, our goal is to provide the most resilience for IT infrastructure. I feel like we're in a good place right now, but we got a lot of eyes on it, a lot of people just focused on it, making sure we stay up 100% of the time.
I feel the consultants like licking their lips, thinking, oh, we can help them with that. But regardless, Ben, just a quick one from me, and I appreciate it. Our meteorologist just said he thinks that air travel is going to be ground to a halt for the next week. Is that true? What's going on behind the scenes to prepare for this storm?
Well, you know, and Bernie he said one thing that always puts shivers down my spine when he said about ice.
Yes.
And I will tell you, being an operator for, you know, over 3 decades, airplanes and ice just don't mix. And when you're talking about a 1/4 inch of ice, it is so difficult to de-ice airplanes that have that much ice on them. It takes so long. And I think that's what airlines do. For us to operate safely, the throughput out of an airport just comes to almost a grinding halt, and you have to really meter the departures out. And I think the best thing airlines can do is really cancel ahead of time to give travelers an idea of what they can expect. So based on those weather predictions, yes, you're going to see a lot of reductions, and closer in, you'll see everyone kind of dial in exactly what needs to happen to provide the most assurances for travelers. But it's going to be ugly. We're taking down our schedule to the East Coast. Now, fortunately, we're on the West Coast, the bulk of our operations, but we got pounded with rain and you know, all that stuff. So we had our stuff as well. But I'm hoping it's not going to be as bad as it is, but it looks pretty dire right now.
Yeah.
Hey, Ben, what's your exposure in terms of your route network on the eastern half of the United States? Because clearly, as you mentioned, you do have flights into New York, into other cities in the East Coast. What's your exposure percentage-wise of your domestic routes?
You know, we probably, and Phil, I'm just going by memory, but at least 20% of our operations head east. So it's quite a bit. You know, even though we're West Coast based, we have 20% of our network that flies east on transcon flights. So it's going to be impactful for us as well. Not to the same extent as the East Coast based airlines, but we got to take our schedule down as well.
Ben, we appreciate the time today, coming off of earnings report last night. Ben Minicucci, CEO of Alaska Airlines, joining us. Kelly, we'll send it back to you.
Yeah, give us some good perspective on what we're facing here. Thank you both. Coming up, shares of Intel are plunging after weak guidance and warning of supply shortages. Even with today's drop, though, the stock trades at 82 times forward earnings. We'll have all the details next. Welcome back. We are seeing mostly a down day. Well, at least for the Dow, for the S&P. Although look at the S&P, it could turn positive as we're talking. The Nasdaq is now up 0.4%, and the underperformers, the small caps, which have been on an incredible run. This would end there, I think, 14 days of outperformance relative to the major averages. AMD is also continuing its run. It's on pace for its 9th straight day of gains, its longest win streak since November of 2019. AMD shares are up 27% in that time. Flip side of the chip trade, Intel plunging 17%, on pace for its worst day in 16 months. After disappointing guidance and warning of shortages, let's bring in Christina Partsinevelos to explain. Christina?
Intel is really having a rough day right now, but that's after a massive run-up. The stock has more than doubled, up over 130% in the past 6 months on lifelines from the government, Nvidia, SoftBank, and these turnaround hopes. But this quarter was a reminder that the turnaround is still a work in progress. The immediate issue is a weak first quarter revenue guide, Kelly, that you mentioned. Intel essentially got caught flat-footed by AI server demand. CFO Dave Zisner essentially admitted that on the call, saying the company, quote, wasn't managing the supply to expectations. So now they're out of inventory and capacity constrained on older manufacturing processes they won't invest more in. Three forces are driving that supply crunch. Hyperscaler demand continues to soar for all of the AI data center build-out. TSMC is only meeting about 80% of that wafer demand. And then agentic AI, the bots that are fueling the answers to your questions, is fueling what CEO Lip-Bu Tan called a CPU explosion. Tan said hyperscalers told him this demand isn't just for a few quarters, they expect it to last a few years. So that's good news for Intel and also bodes very well for AMD. Intel expects supply to improve by the end of Q1 and into Q2 and shifted CapEx guidance from down to flat. So that's a signal it's preparing for new foundry customers. But Intel CFO told me not to expect announcements until the second half at the earliest of this year, which was maybe disappointing Wall Street, which had been pricing in faster progress with new customers. The demand, though, is real, but Intel's ability to capitalize it remains the question. For now, the market is reconsidering what it paid for that turnaround story, or as one note I just read from Mizuho saying, look at this, it's just momentum traders that got into the name. It's not trading on fundamentals, and that's why it's down 17% today.
Yeah, I know Stacey Ratzgon was pretty frustrated as well. We'll talk to him next hour. Christina, we'll see you then for more. Christina Partsinevelos. Let's get to Pippa Stevens now for the CNBC News Update. Hi, Pippa.
Hey, Kelly. No signs of compromise yet, but trilateral talks were being held today in Abu Dhabi, where Russian, Ukrainian, and U.S. negotiators are meeting to discuss terms of ending the war. Talks come after meetings between President Trump and Ukraine's Volodymyr Zelensky this week, along with a trip to Moscow by U.S. envoys Steve Witkoff and Jared Kushner to meet with Vladimir Putin. According to TechCrunch, Meta today is suspending teen access to its AI characters worldwide as it looks to develop a special version just for teenagers. The moves come ahead of court proceedings in New Mexico, where the social media giant is accused of not sufficiently protecting kids from sexual exploitation on its apps. And the city of Philadelphia has sued the Department of the Interior after the National Park Service on Thursday removed an exhibit on slavery to comply with President Trump's executive order to, quote, restore truth and sanity to American history. The president signed the order last March, in which he blamed the Biden administration for advancing a corrosive ideology at the country's historic sites. Kelly?
All right, Pippa, thanks. And check out the Nasdaq, which is clawing its way back into positive territory for the week with today's small gain. This is a big deal. Keep an eye on it. And with the framework of a deal in place for Greenland now, can geopolitics move to the back burner so investors can focus squarely on earnings? We'll talk about that and the volatility we're seeing next.
Do not trade geopolitical headlines. That's the insistence of our next guest on the back of this volatility we've seen all week. Although it's been a straight line higher for the metals trade. Gold on pace for its best week in nearly 6 years. Silver above $100 an ounce today for the first time. So what should investors do now? With us is Matt Miskin, the co-chief investment strategist at Manulife John Hancock. Matt, it's good to see you. And I mean, where would you have us start? It sounds to me like you're backing a little bit away from the Mag 7 and looking more to the value side of things. Is that right?
Yeah, Kelly, quality value is our mantra right now. Industrials are our favorite sector as we're starting to see higher return on equity, good solid companies seeing a pull through of demand. Earnings estimates into 2026 look rich to us on the tech space. They're looking for like 20 to 30% earnings growth on top of 20% last year. Industrials looking for 16% earnings growth. We think that's legit after a tougher year this year. We're seeing industrial companies likely of the biggest beneficiary from the One Big Beautiful Bill, accelerated depreciation. It's going to spur some tech capex. And what you're seeing in the aerospace and defense industry is really humming along here, ready to take flight. So that's what we see.
Listen, we were just about to put that. Maybe they can put it back on the screen. Boeing is up 40% since November. Defense stocks have outperformed all but about the memory trade part of AI. I mean, it's almost as if instead of, if you're saying investors shouldn't trade geopolitical headlines, it's almost like you say just own geopolitical risk in the form of defense stocks and I guess in the form of the metals.
Right. And, you know, in the metals right now, one of the other big lessons we're trying to, instill in investors is to not get the case of the FOMO. So fear of missing out right now is what we're seeing in the metals. I'm cautious there. I think that actually trimming into strength, it might be a better idea. But in terms of the industrial space, this is a part of the market that has been relatively quiet for years. It's not been the hype of the AI, but it's more so, it is the AI data center build out. That is part of it, but it's got other things. Aerospace and defense demand is still strong. We're seeing onshoring, CapEx. The Midwest is booming with manufacturing renaissance still here right in America.
You like the industrials, you like the mid caps. I've had some audience members say they're glad to see the mid caps participating. They don't love it when the Russell's outperforming. I think everyone's harping on the Russell a little too much. I like to see the small caps up there and the mid cap. Maybe they're low quality. Maybe it just is a sign that there's possibly earnings momentum elsewhere and not just in mega cap tech.
Yeah, and so amidst the small and mid-cap trades, the biggest difference you get is it's more industrials and mid, and in small, it's more regional banks. And regional banks actually coming in strong here. So they're growing earnings at double digits. You're seeing nice M&A activity, steeper yield curve. The wealth management business is doing well. But the problem is that you can get these headline risks. You can get things like regulation. You can get things like just the markets are so sensitive to it. So regional banks having a tougher day today. We think industrials, given the pipeline of demand, given the CapEx and everything else that I already referenced, might be a better spot.
So it's coming, you mentioned those results coming in hot. What about the whole idea of the run it hot trade? What does that tell you? I mean, is that also, you mentioned a lot of this is FOMO in the metals, but do you think that's what's happening here is true to the administration's word? They're just running it a little hot right now?
The hot isn't. I think it's warm, and up here in Massachusetts, outside of Boston, I'll tell you, we would take some warmth and a lot less snow than we're about to get. But what we're seeing here is good growth with less inflation. This is the opposite of stagflation. I heard so much stagflation at the end of last year. In terms of the economy heading into January, it's accelerating, but not like too hot. Like the PMI and the ISM might hit just above 50. That's good. And then inflation is staying in check. Housing is actually modest growth. Housing prices are moderating. Energy prices, they're up. Oil's up today, but all things considered, not that bad. Wage growth into 2026, we think moderates. Our biggest non-consensus call is inflation moderates into 2026. That's actually a pretty bullish thing, though.
Wow, that would be extremely bullish. That would be very, very good news. I know, like you said, a lot of people are getting more concerned about it, but you're saying it's warm, not lukewarm. That's not good. We want it just nice and warm. Matt, thanks. Appreciate it today. Matt Miskin joining us. Thank you from Manulife. Coming up, brace yourselves. There's another big shift underway in AI, and it could be even more lucrative than chatbots. We'll reveal that next on The Exchange.
OpenAI might be under a lot of pressure lately, but Sam Altman is putting the spotlight on a fast-growing part of the business, separate from ChatGPT, as the race for AI maybe moves beyond chatbots. Deirdre Bosa has more in today's Tech Check. Deirdre?
Hey, Kelly. So the race is moving from what we see and prompt as chatbot users to what powers the back end for enterprises and developers. The metric, which you're going to start hearing a lot more about, is API usage. So the software talks directly to the model. One system sends a request, the AI sends back an answer. When a company uses an AI API, the model, that could be ChatGPT or Gemini or Claude, it's running inside. It could be inside enterprise software, drug discovery tools, scientific simulations, anything else. So OpenAI, Google, and Anthropic, they all charge for API usage. That is what makes up revenue streams like enterprise. But as that side of the business grows, OpenAI CFO Sarah Friar, she floated the idea of a value exchange model as another opportunity. In other words, OpenAI could take a cut of its customers' AI-aided discoveries. Now, some of the immediate feedback pointed to the irony of OpenAI scraping vast amounts of copyrighted data to train its models and then turning around and asking for a share of the value created on top of that intelligence. But another way of looking at it, Kelly, is that this is exactly how frontier technology gets funded at scale. That is by tying the economics of the model to the breakthroughs that it helps unlock. Now, it all does raise a bigger question about AI economics, who owns the inputs, who gets paid for the outcomes, not to mention the mechanics of actually executing this kind of a revenue share model. Seen together, though, you had ads earlier this week, and now this, it really shows the pressure on OpenAI to find revenue streams that are big enough to support OpenAI's commitments, more than $1 trillion worth of them that are already locked in.
I mean, people have a lot of questions about how it would work for them to take a cut of things you create with AI. I mean, I'd never use it again if I thought that was a real issue.
Right, but I don't think it's for people like you or I don't think they're going to want a cut of my Evado-meter if I use that with Codex, you know, ChatGPT's AI coding assistant. This is probably meant for large corporations, and what Sarah Friar floated was the idea of working with big drug discovery companies or pharmaceuticals and creating some kind of structure that would be beneficial to both. But your skepticism, Kelly, is probably like the prevailing narrative around this at the moment. I talked about the irony of them scraping data and turning around and charging for that data that they scrape. But I mean, they would argue that they've done something
I kind of understand where they're coming from.
And they can charge for it.
Yeah, like I take their point that, look, if we're going to help in this, we should get a cut. But unfortunately, it's a dog-eat-dog world. If the other platforms are available to use and they're not making the same demands, why would you agree to theirs?
I'm so glad you picked up on that. I didn't want to add that other layer, but that's exactly right. And it could be, you know, a case for open source models, which wouldn't be able to have that kind of structure. They may not be able to make money, but they wouldn't have that kind of structure. And we know that they're becoming just as good as some of the most competitive frontier models.
And from China, no less. So you can, really see where that would be going. Yes, yeah. Deirdre, thanks. Deirdre Bosa. Coming up, American TikTok users rejoice. The deal to keep your social media service available in the U.S. looks to be closing at the 11th hour. But the cyber expert who helped shape the original ban still has concerns. And we will share them and talk about whether user data can be truly secured after this. It always seems to end with a whimper. Social media stocks are slightly higher today after the deal to keep TikTok in the U.S. was finalized yesterday. Let's bring in Julia Boorstin to tell us how it's going to work. What are the details? Hi, Julia.
Hi, Kelly. That's right. The TikTok app on your phone has new owners in the U.S., and its algorithm is being retrained on U.S. data. Now, the new company's majority owners are Oracle, Silver Lake, and Abu Dhabi-based MGX, with 19% still owned by ByteDance. And the app's 200 million U.S.-based users will not have to download a new version of the app. Now, the threat of being shut down may be gone for TikTok, but plenty of challenges still remain. It's unclear how this new version of TikTok will be different for users and if the return on investment will be the same or worse for advertisers now that the app is run on a license of the Chinese algorithm retrained on U.S. data, with the U.S. company deciding what kind of content is allowed. Now, uncertainty about TikTok's future was seen as a benefit for rivals Meta, Snap, YouTube, and Pinterest. Brands may still hedge and wait to move dollars back to TikTok until its new return on investment is clear. A key risk for TikTok now is the threat from Instagram's Reels, which is on the rise in the U.S. Average time spent per user on TikTok has fallen from 1 hour per day in 2023 to 52 minutes this year, according to eMarketer, while Instagram's time spent has risen from 33 minutes to 36. Now, on the flip side, an area poised for growth now is TikTok Shop. The company is expected to aggressively ramp its e-commerce business, which could challenge players from Shein to Sephora. eMarketer projects that TikTok Shop will top $20 billion in U.S. sales this year, growing to $37 billion by 2029. Kelly?
I think you're right about Instagram. Sully and I were talking about this yesterday. I give them a lot of credit. The algorithm, I don't know if it's AI, has really gotten a lot better, and I seem to hear more and more about that. Julia, thanks very much. Julia Boorstin. In any case, this TikTok deal is already under scrutiny from lawmakers. Democratic Senator Ed Markey of Massachusetts is calling for Congress to investigate the deal, saying in a statement more details from the White House are needed, quote, including whether TikTok's algorithm is truly free of Chinese influence. My next guest is one of the key experts who testified before Congress recommending a sale or ban of TikTok nearly 2 years ago. Let's bring back Ivan Zarini, the CEO of cybersecurity company Ferroot. Ivan, it's great to see you. It's been a little while. What's your reaction to the deal?
Yes, thank you for having me. First of all, it's great and amazing news for all of the TikTok's users that the app it will be still in business and everyone will be enjoying it moving forward. So, and one of the main concerns is definitely taken care of, such as governance of privacy and security of Americans' data is now in the hands of American executives.
You sure about the, that's what they're all saying. I want to know what you think. Is that definitely the case? Is there still, how exactly is this going to work? And more importantly, should I finally download TikTok on my phone and feel completely fine about it, that I'm not helping to train AI algorithms and models back in China?
Yeah, Kelly, really interesting question. I'm not going to endorse either way to install the app or not. But from security experts' concerns or point of view, there's definitely one concern that kind of stood out from the announcement and the news. And one of them is that ByteDance global arm will still have an over management and access to TikTok's e-commerce, advertising and marketing capabilities and tools. And why this is important is the data that is collected by marketing tools is not going to be used for surveillance and spying on Americans. Just like we raised the concern 2 years ago where we found that TikTok was collecting data on Americans that have never even used the app. So this is still a concern to be addressed.
The e-commerce is specifically the concern for you now.
Yeah, e-commerce, also advertising and marketing, because what's happening in a privacy and a security kind of world is that commercial tools do collect data, real-time information on all of us. And then that data can be used for dual purpose, obviously for commercial and business purpose, but also for surveillance on us. Right. And why that is important, because we're in the AI race, right?
But are you saying that the same data, it's just usage, what am I looking at, right? You're saying that in order to collect advertising information, basically what I'm looking at could still be something that the Chinese have access to.
Yeah, you're spot on. I'm glad you picked on that. It's what is really important from marketing and advertising point of view is that the same data that watches what you do, what you see, what websites you're visiting, what you're doing on your phone can still be used for training, for example, AI and Chinese AI tools and AI models. And that gives them real-time competitive advantage over any of the American AI.
So what's the difference? If they can still do that, what is it that they can no longer do?
Well, that's an important question. Very likely they're no longer able to use the data that is collected within the app itself when you are using the TikTok app in the US. But the data that is collected outside of the app, we don't know if that data is going to be governed by the new TikTok entity in the US, or it's still going to be governed and accessed through China.
Got it. Well, then we'll have them. I'm getting to the point where I'm just going to download it. I just like, I don't know anymore. I can't, but no, Instagram has been plenty fine in the meantime. I appreciate you spelling out those concerns more clearly, Ivan, as lawmakers will turn more attention to it, and we'll see if they can alter this to address them. Ivan Serenia-Farooq, thanks so much. Appreciate it today. And that's it for us. Thanks for watching The Exchange. I'll head over to join Dom Chu for Power Lunch right after this break.
All right, happy Friday. Stocks are trying to close out the week in positive territory. Welcome to Power Lunch alongside Kelly Evans. I'm Dominic Chu in for Brian Sullivan today. We've got a very big week for your money coming up. 20% of the S&P 500, a fifth of it, reports earnings, including some of the most powerful Mag 7 stocks that could move the entire market and maybe will. Plus, the decision everyone on Wall Street is waiting for, which is the Fed one on interest rates. Investors will be listening closely to Chair Powell. And joining us to navigate and make sense of all of this is going to be Torsten Slok, Chief Economist over at Apollo Global Management.
Look forward to that. He's standing by in just a moment. We're also following two big movers today. Intel has more than doubled in the past 6 months, but is down big after soft guidance and inventory shortages. That left one analyst asking, how did this happen? And that analyst, Bernstein's Stacey Rasgon, will join us in a bit. And also, all bets are on as Kalshi has launched its sports prediction markets 1 year ago today. That marked a significant shift for the platform. And since its debut, sports have become the dominant force on its exchange, now accounting for 90% approximately of its total trading volume and impacting sports betting names like Flutter and DraftKings.
All right, well, stocks are getting a lift this morning from some stronger than expected consumer sentiment data for the month of January. The data came in at 56.2 when the consensus estimate was 54, so a better reading. Even still, though, the Dow and the S&P 500 are tracking for a negative week overall. The Nasdaq is on pace right now to narrowly eke out some gains. This all sets the stage and table for a huge few days for your money coming up next week. We're going to get several of the tech megacaps reporting earnings, the likes of Meta Platforms, Tesla, Microsoft on Wednesday, and then Apple on Thursday. Also, key consumer reads with the likes of Starbucks, Visa, and American Express, amongst others. We're also going to get the first FOMC meeting of the year where rates are expected to remain steady and unchanged. So joining us now to preview the massive week ahead is Apollo chief economist, the previously mentioned Torsten Slok. Torsten, thank you very much for joining us on this Friday afternoon. With all the catalysts I just mentioned, what do you think is going to be the 1, 2, or 3 maybe that are the most important for you?
Well, there are two things that will be important. Number one, of course, will be the Fed meeting. It's very important how the Fed communicates about the future. It's very important how the Fed talks about how much weight they put on inflation, how much they would put the weight they put on the employment part of their dual mandate. But the other thing that's also important next week is exactly as you're saying, Dom, that earnings that reveal more about the consumer will be very critical. The U.S. economy last year was facing headwinds from the trade war. Those things are now more behind us, and now we have a number of tailwinds. We have lower oil prices, we have a weaker dollar, we also have the one big beautiful bill, and at the same time, the AI and energy data center build-out continues. So for that reason, we are beginning to see more tailwinds to the outlook. So seeing how the consumer is doing and what the Fed will say next Wednesday are the critical things next week.
No, Torsten, over the past few weeks, we've spoken to you and a number of strategists and analysts and economists talking about this notion that this kind of quarter right now, the one looking at the fourth quarter of last year, is going to be one that's more of a transitionary period, right? That we haven't seen the full effects of some of the macroeconomic stimulus and fiscal policy that could be a massive tailwind, hypothetically, for companies in 2026 overall. With that in mind, are there certain specific stocks outside of just that consumer realm that are going to set the stage for what could be a better 2026?
Yeah, and that's absolutely correct, because remember we had the government shutdown in the fourth quarter, and that's of course going to create some lift in GDP in the first quarter and coming into 2026. And when we think about what is in the one big beautiful bill, that should give us some hint at which sectors in the S&P 500, which sectors in private credit and private equity that are going to see a tailwind over the next several quarters. Because the one big beautiful bill clearly has two key components. It's going to be helpful for U.S. consumers, and is also going to be helpful for CapEx. Remember, the key part of the one big beautiful bill is that the immediate expensing, that companies can now write down 100% of their expenditures. Normally, companies write down their CapEx over a period of 5-10 years. But now we can have this year that companies can write down immediately their expenses, and that should give a lift to the sectors that are benefiting when CapEx is strong.
Do you think Rick Rieder is going to be the next Fed chair, Torsten?
Well, it's a very difficult guessing game, Kelly, here. But of course, this is what prediction markets have been saying here in the last few hours. So that certainly is the way the wind is blowing at the moment. But we really don't know yet who it will be. But no matter who it is still the case that there are 12 voting members on the FOMC. 7 of them are the governors and 5 are the regional Fed presidents. So whoever it is, the incoming Fed chair will have to try to persuade the other FOMC members if that person thinks that interest rates should be lower. And that is the challenge, namely whether that will be successful or not. And at the moment, it's very clear the dot plot for this year says that the Fed only expects 1 cut in 2026. The market only expects 2 cuts. And interestingly enough, the market is actually pricing that the next move in 2027 is a hike. So you are now looking at a situation where rates are going to be higher for longer, and whoever the Fed chair is that comes in will still have the good news that the economy is actually doing really good in the background.
You know, Torsten, despite all the geopolitical rhetoric around Davos this time around, we did see a spike up in longer-term government bond yields here in the U.S. We've seen similar moves in other parts around the world, but they didn't really break out that highly. What does it say to you right now about the bond market in the U.S. specifically if we have this kind of potential catalyst on the geopolitical front and no real sell-off in what's happening with U.S. Treasuries?
Yeah, that's true. And that's why rates have just moved, roughly speaking, sideways in the US. The interesting thing when you compare this globally is, of course, we have something very important going on in Japan where yields have gone up, and yields have also gone up in Europe because they also have fiscal challenges. So it's not unique to the US that there are fiscal challenges for the politicians to deal with. This is what we see everywhere. So from that perspective, my expectation is that front-end rates will stay higher for longer because inflation is staying higher for longer, and long-end rates will stay higher for longer because globally there are fiscal challenges. So the bottom line is the whole yield curve is likely to stay at these more elevated levels for the better part of 2026.
All right, Torsten, we also want to bring up something with regard to our market dynamics here on the stock side of things. What do you think about this move that we've seen in small cap stocks? The Russell 2000 outperforming the S&P for the past 14 straight trading session. Is the rotation real, and specifically the rotation we've seen in just the last couple of months?
Yeah, that's really worrying, Don, because if you look at underneath the hood of the Russell 2000, most of the performance in the stock market has been coming clearly from those companies that have negative earnings, whereas those companies that have positive earnings in the small cap world, they have been underperforming. And that's really, excuse me, weird. Why is it that companies with negative earnings are outperforming companies with positive earnings? That's not the way it should be. So if we do have now some tailwinds building in 2026 with tailwinds, again, from the one big beautiful bill, from lower dollar, lower oil prices, the AI and data center build out, all those things does mean that we should begin to see some tailwind to all stocks and, of course, to all companies in corporate America. But the performance in the last few months is really unique and unusual because it should not be the case that companies that have no earnings are outperforming companies that have positive earnings.
And that's a good place to leave it. Torsten, thanks so much.
Thank you.
Good luck. Do you have a shovel? What do? You got guys for that? Are you
I live out here in Brooklyn, and absolutely we have shovels ready. So the winter coming is absolutely, we're prepared.
A lot of sidewalk. I'm glad I'm not a sidewalk person.
I got driveways and yards. I got to shovel.
That would be a lot of pressure. Yeah. Torsten, thanks very much, Torsten Slok. Let's turn to the bond markets where 10-year yields are around 4.25 after consumer sentiment hit its highest level since August. And all of this comes with next week's Fed decision looming. Rick Santelli has more. Hi, Rick.
Hi. I don't know if looming is the correct word for next week's Fed decision. I think it must be more about snoozing. Market has no notion of anything significant happening next week with regard to the Fed. Look at a 1 week of 10s. What you should notice is, yes, we touched that 430 level early in the week, and that was predominantly because of the effects of Japan. Let's look at that breakout. Our last guest talked about not much going on with the long end. I disagree. There's a chart starting in early December. We definitely popped out of that range in the catalyst. Add in the Japanese 10s, and you can clearly see what the catalyst was. We continue to track the long end. It's not the same for short and mid rates versus Japan. It really is about the long end, and anything beyond 10-year, whether it's 20, 30, 40, 50 in any country, it's an interesting parlor discussion, but that's not where the action's at. And with the Bank of Japan holding pat as expected, but a lot of verbiage regarding all these moves in foreign exchange. Look at a 1 month of the dollar yen. It had a big correction against all the majors. That one's against the greenback. But when you open it up to where we're coming off of the best levels on the dollar since July, it's only a small move, but we need to pay attention to that 160 level. Dom, Kelly, back to you.
Thank you, Rick. Really appreciate it. Rick Santelli. Intel investors, look away. The stock is pacing for its worst day in nearly a year and a half. Although, come on, what are you complaining about? What a run it's been. But Stacey Rasgon is a little frustrated. We'll see if he's less or more so this afternoon when he joins us next with his take on Intel. Shares of Intel are down almost 18% now after the company issued a weak forecast last night after its fourth quarter results. Now, they've been spending heavily to ramp up production of their latest chips while dealing with an inventory shortage. Christina Partsenevelis joins us from the NASDAQ with more. Christina, sometimes we see these companies, they have horrible after-hours trades, then they kind of recover the next day and it's not so bad. Well, this is a different story.
It's the day after. Give it maybe another week, and the fact that you're seeing AMD climb a little bit higher on some of the strong commentary on yesterday's call with Intel could bode well for Intel in the coming months. So I would still give it a little bit of time, especially retail traders. But shares overall, just over the last year, they're giving back some of that rally. Look, they're still up 107%. The sell-off came after earnings showed Intel has a, quote, high-class problem, as the CFO described to me on a phone call, but it's still a problem nonetheless. CFO Dave Zizner essentially admitted Intel got caught flat-footed by exploding AI server demand. They burned through inventory and are essentially capacity constrained on older manufacturing processes, I should say, the same ones they won't invest more in because that's not necessarily the future. So they're kind of stuck in this situation. The upside is this demand isn't a blip. CEO Lip-Bu Tan said hyperscalers expect CPU demand to last for years, driven by a, quote, CPU explosion from agentic AI. And this bodes well for AMD as well. Intel expects supply to improve by end of Q1 into Q2. They shifted CapEx from down to flat, so not as bad, preparing for foundry customers. The balance sheet improved cost-cutting and backing from, of course, NVIDIA, SoftBank, and the United States government. But the CFO told me not to expect foundry announcements until the second half of this year at the earliest, and that they may not even name names because it's sensitive. Wall Street had been buzzing with rumors about signed customers like Apple, for example, which did help drive that rally over the last several months. But Intel has said that the demand, the question is whether, I should say, they can actually fix supply fast enough to capitalize on this demand, Kelly.
Indeed. Christina, thank you very much. We appreciate it. Let's get one top analyst take right now who last night said, what happened? Stacey Rasgon is managing director and senior semi-analyst at Bernstein Research. You've got a market perform $36 price target. But Stacey, I just want to make sure everyone's understanding. There's some stocks that are more emblematic, right? NVIDIA tells us a lot about the AI trade. I'm not sure if Intel is telling us anything other than what's going on with Intel, which right now seems to be, like, to your question, why is there all this inventory, but it's not getting anywhere? What's going on with the foundry?
Yeah.
In other words, all these kind of company-specific challenges. Is that right?
Yeah. Yeah, and to be clear about it, I'm not frustrated. Like, I don't know why you would say that. Yeah, it was. So yeah, I think Christina set it up pretty. They are kind of stuck, right? They absolutely got caught flat-footed, and it's a shame because, again, as I said on the call last night, they have their own factories. Like, in theory, they could have been incredibly well positioned to capitalize on what seems to be a very strong demand environment, but they just weren't there. And in fact, it was quite the opposite. They were actually scrapping equipment 2 quarters ago. And on the July call, they took an $800 million charge for basically like accelerated depreciation on older equipment that they couldn't find reuse for. So they were selling that off for pennies on the dollar. And clearly, they weren't doing that because they expected demand. And I get it. It's hard to forecast demand. Like it is, I understand. And it's easy for me to sit here and opine. But at the same time, it's kind of their job to do it. And they clearly messed up. Like somebody messed up big time. And so now we're in the situation. And to be fair on the stock, whether you got to remember, it was here a week ago also. So
totally, some
of the decline we're seeing is just the stock probably shouldn't have been $55 going into the print yesterday either. So I mean,
still
some of it's
trading
just giving it back.
An 82 multiple.
Yeah, earnings multiples on this stock right now are probably not as meaningful because the hope, if you're owning it, is that earnings number is going to go up a lot as they get scale. And like that's the thing. So you look at where they are now. The positives are. There is strong demand. And so if they can relax, ease the supply, like they can maybe capitalize it. And they did launch 18A and it's ramping, and Panther Lake, which is the client product on that, looks good. And, he talked about increased engagement on 14A, and so, which is the next process, and that's all fine. But at the same time, like there's a lot of hair on each of those. So this demand is good, but they can't capitalize. 18A is ramping, but it doesn't look like the yields on that process are ramping any faster than they thought. Again, I think expectations got really ahead of themselves in terms of what we might hear for customers for 14A. And even if we do get them, they're not going to see revenue for years. Like this is still a massive turnaround story that got way out over its skis on vibes and tweets. You know, it's up was up 47% in the last 3 weeks on basically nothing. And it's going to give some of it back to today, and deservedly so. It shouldn't have been there in the first place.
I mean, Stacey, the stock is down 18%, and yet it's still more than double over the course of the past 12 months.
Yeah.
Now, the reason you mentioned social media, the reason why this is interesting is because you got a decent amount of social media noteworthy response and comments because of the question that you posed to management during the analyst call. And I'll simplify it. You just asked what happened in a very skeptical tone. So we know what happened. We know what the response was. We see the stock reaction today. What needs to happen in order for this story to become a more longevity-based turnaround story that actually has legs and gets us back to those all-time highs that are something like $70 split adjusted from the dot-com era?
Yeah. Sure, and I will say, like the CEO Lip-Bu, I think Lip-Bu's doing the right things, right? So what did he do? He got the cost structure in place, whereas like Pat Gelsinger was like hiring like crazy, like into a vacuum. He had to get rid of all those people. So Lip-Bu's getting the cost structure in place, simplifying the organization, bringing talent in, you know, giving customers what they want. You have to remember, like he knows how to run a foundry. Like he was one of the founders of SMIC, and he was on the board there for 20 years, and he ran Cadence, who's an EDA company. He knows the ecosystem. He's got a bunch of startups that are all customers of TSMC. So he knows what customers want. So he's putting that customer mindset in place, which is really important. And he's also trying to underpromise and overdeliver, which is the opposite of what Gelsinger was doing. So those are all good things. At the same time, it's going to be a slog. And I think I've said here before, like it took 10 years to break it. It's probably going to take 10 years to fix it. That would be like the end of the decade. So he's doing the right things. We'll see if the demand is there. Clearly, they have to get the process technology and everything on par and attract customers. And maybe they can do it. Maybe they can't. Like, I don't know. He's doing what he needs to do at least to get them along that path. But we're not going to really know if this turnaround is valid or not for years. Remember, it's. I think he may have even said this on the call. It's a battleship, right? It doesn't turn quickly. It's going to be a slog.
Well, very well said. Stacey, thanks for joining us on that today. Appreciate it. Coming full circle. And again, illustrating, Dom, the challenge. This is why it was to a question to Christina. This is why the shares aren't recovering today as investors digest this message.
It's also about whether or not those investors are going to have the patience to wait out till the end of the decade, knowing full well, I should say, by the way, that the U.S. government is a strategic investor in this company now as well. So it's going to be a big story.
No, it's a great point. And there are the shares pretty much at session levels.
Right. All right. Well, we're going to stick with the tech story here. Take a look at what's happening with Apple right now. They're on track for their 8th straight losing week. Now, the last time those Apple shares had that kind of a streak was back in 2022. And if it falls again next week, remember, earnings is a catalyst, it would be the longest weekly losing streak going all the way back to 1993. Certainly a stock to watch, and certainly one with earnings coming up.
If we do 9 weeks down, we haven't done that.
Go back to 1993.
What would be the number to watch? How much are we down on the week right now?
I would say over the course of the past week or so, look at that, just about maybe.
I mean, we'll come up. We're down.
It's
We're down
about
3% on the week, so we're not even close. So it's going to be 9 straight weeks of decline, basically.
If it doesn't get something next week, that gets it above 3 or 4%, right?
So next week is the 9th week.
Next week, if it closes down next week, it would be 9 weeks.
All right.
All right. So a major milestone for a precious metal coming up. Silver hit $100 an ounce for the first time ever as gold inches towards 5,000. Do they have more room to run, or is it just time to fade Wall Street's hottest trade? We'll discuss that after this. right, welcome back to Power Lunch. It's time for today's trending ticker. And the most searched name on the entirety of CNBC.com's website this afternoon, it's not glittering gold, it is shimmering silver. The precious metal has doubled over the course of the past 2 months, hitting a new record high today after surpassing $100 an ounce and now trading above the $101 mark. These are all record levels for silver. It's not, though, the only commodity that's rallying. Other names, like gold, of course, platinum, palladium, are each higher and approaching their respective all-time highs as well. So let's welcome in our next guest, Philip Strebel, the chief market strategist over at Blue Line Futures, to help break down what's been going on in the metals trade, specifically with regard to the precious ones for right now. Philip, when you look at these charts, how much can they go further to the upside?
Well, I mean, we see a scenario where gold futures could hit $5,500 in 2026. We see another scenario where futures on the silver market could hit 115, 120 based on volatility. It's really driven by that continued central bank buying, the private investor ETF flows, the Fed easing. We expect 2 interest rate cuts, the first one in June. Also the focus with that next appointed Fed chairman. So you get 2 main structural drivers that continue to support and strengthen gold and silver. It's a central bank buying. They're diversifying away from U.S. dollars and other currencies. We saw Poland this week add another 150 tons. Meanwhile, India is cutting their U.S. Treasury holdings. They're taking larger stakes in gold. And then you get those ETF flows, and that's where silver comes into play. So we're experiencing multi-year increase in gold ETF holdings. Individuals, institutions are really cementing it as a portfolio of strength or a position within their portfolio. So the 60-40 portfolio, really it's dead here, and they're adding these strategic commodities such as gold, silver, and copper for portfolio diversification to help fight inflation and also geopolitical risks.
Yeah, I take the philosophical point 100% absolutely. But I mean, I see longtime market observers saying, kind of now telling people what to watch for when the rug's going to get pulled out. And we know there's a lot of hedge fund participation in these trades. That hot money can come and go very quickly. So as soon as there's some kind of margin call event, I mean, this just can't keep going up the way that it's going, Philip, for much longer. And I'm not saying it goes, down significantly, but some kind of reset. So shouldn't people at least wait for some kind of better entry point than jumping in right now?
Well, yeah, the question is, could prices pull back? And while some pullback is reasonable after such rapid gains, it's the fundamental underpinnings of these metals that sustains this type of rally. Could gold fall 10%? The average true range on it is like $95 a day right now. Silver is $5 a day. You strap together 2 straight downward days in those markets, you're going to see a massive sell-off there. But the leadership of things like silver really reflects the broad repricing of these metals. So you've got multi-year supply deficits, industrial demand, investment demand. It creates this perfect storm where this demand outpaces that supply and it pushes prices to record highs.
Now, Phil, the other, I guess, maybe participant in this whole thing, outside the hedge funds themselves, are some of the market makers and the people who are actually selling some of these products to the market here. They're short, in essence, for some of these things. Is this possibly part of a larger short squeeze that's going to affect some institutions at some point who are on the other end of a rising price in silver?
I mean, we've seen that before. We've seen it play out in other commodities like natural gas and some of the smaller commodities out there where you do get that type of squeeze in play. The reality is that, I mean, those are hedges that are on their books that at some point will have to be realized and will have to be unwound. Do they have the physical to back up a lot of these paper shorts and things like that? I mean, we were seeing it in markets like platinum and silver making new highs right now. I mean, platinum is a much smaller, cheaper alternative towards gold. That market size is very tiny. You've got 70% of platinum comes from South Africa, where they've got electricity outages, aging transportation. So the process of moving platinum from these mines to the end user really creates that scarcity and tight inventories. Russia's the other big player. They account for 10% of the global production. So it's that scarcity and the widespread application that we're seeing with AI and everything else that's really making this a unique situation in the metals.
All right, so you just kind of addressed maybe part of my next question, which is many of these precious metals have these industrial applications. So when it comes to things like the platinum group metals, palladium, gold, silver, Which one has the better fundamental case? They all have fundamental cases. Which one has the more upside when it comes to industrial use, given this AI/clean energy economy that we're evolving towards?
I mean, copper is definitely the backbone of the metals complex. And look at the global economy has been taking off. Copper is one of the best reflections of that. We've seen a number of supply outages in some of the world's largest mines, and that's caused a bit of a squeeze. But you get this trade concern, which has drawn global copper inventories into the U.S., and it tightens conditions broadly and globally. It's the global transition here of clean energy, electrification that is really driving the demand for copper. You've got the EV vehicles, you got the data centers, the AI, the renewable energy, and they say that the widespread, the grid and the power infrastructure is going to drive about 60% of global copper demand growth throughout the rest of the decade. I think that that's where your longer term play is. I look at it like number of horses in the race, and I think that gold and copper are kind of my two that I stick with all the time. But it's, you know, it's the silver, it's the platinum that are the outliers that go there, and they're playing catch up and they overshoot.
Yeah, overshooting is especially, a lot of people are drawing lines to what's going on in Japan, and I think there's more work on this to be done. But Phil, for now, thanks. We appreciate it. Philip Streibel with Blue Line Futures, Chief Market Strategist.
All right, coming up, snowed in and tuned in. Why this weekend's winter storm could be good news for the NFL. That story up next.
One of the biggest snowstorms in years is set to bury areas from Oklahoma City to Boston. AccuWeather's Jeff Cornish has more on the forecast. And we just want to make sure, Jeff, that Denver and Seattle will be we need events to happen there this weekend. Go ahead.
Absolutely. It'd be very different if New England were home this weekend. But that game out there in Denver will have lower impacts. We have huge impacts, though, for most other areas southeast of Denver and all the way through the East Coast. So the southern U.S., the eastern U.S., the biggest winter storm in years for many of us. 200 million impacted. This is going to shut down travel for most east of the Rockies into early next week. Freezing rain, a huge storyline beginning in places like Dallas later this evening and then expanding east into Atlanta, Georgia, into the rest of the weekend and across parts of the South. Heavy snow is a big storyline as well. So regarding the ice, this evening we're going to go from rain to freezing rain to sleet in Dallas, and we're going to be very concerned about a large area of power outages associated with the freezing rain. It lands as a liquid and glazes the power lines, the tree limbs, shutting things down here in many areas across the South. A little farther north, it's colder. We're looking at a broad stripe of 6 to 12 inches of snow from the southern plains, and some in the Northeast will see over a foot, the hardest hit in several years for the I-95 cities, changing to a little sleet at the end. Back to you.
All right. Thank you very much, Jeff, for the weather forecast there. Hopefully everyone stays safe. Now, from the expected massive snowstorm, let's get on over to the big weekend of NFL games that Kelly just alluded to, and those two things may actually be related. CNBC media and sports reporter Alex Sherman is here to tell us why. And yes, I think for many of us here in the Northeast, Alex, we will be tuned in intently because we have nowhere else to go.
Right. I mean, logically speaking, you would assume that TV ratings would be up if you're in the house and you don't have anything else to do, to your point, barring those power outages that you just heard Jeff talk about. So I called around to some sports media executives, some sources at Nielsen, and I said, look, does the data back this up? And they basically told me, yeah, it does. Usually it's more localized, such as if there's a bad storm and the Tampa Bay Buccaneers are playing, then you'll see the ratings jump in Tampa. What's interesting about this game is that the AFC Championship and the NFC Championship are two of the highest rated games all season for anything on TV. After the Super Bowl, often they're number 2 and number 3. Last year, you had over 57 million people watch the AFC Championship game. And the other interesting thing is that this storm is so large, as you just heard, 200 million Americans affected. So you're already seeing sports events canceled from Texas over to Washington, D.C., to Connecticut, things being shifted around. So I tried to figure out, is there any real parallel for this? A big national game with a huge winter storm. And I found one. In 2015, the Super Bowl had a storm very similar to this. Over a foot of snow from Iowa all the way to the East Coast. And do you know who played in that Super Bowl? Seattle and New England. Is that an omen? I don't know.
It could be, and those are the two favorites, by the way, I believe, in these two championship games for sure. One other point about this, if you take a look at the way things are stacking up, Alex, if you look at the way the weather is shaping up with these types of events, there is a tailwind for ratings, there's no doubt. What exactly is the other part of the media landscape going to be like this weekend outside of the NFL? Are there other things that people will be tuned into as well?
Yeah, I mean, there'll be all sorts of, college basketball games and so forth. But one thing that jumps to mind is that the UFC actually debuts on Paramount Plus. So this is a brand new contract that UFC used to be paywalled, in essence, pay-per-view, their big events, or you could find it on ESPN. This will be the first time that one of their big events is actually unpaywalled. You can get it. Anybody can get it that is a subscriber to Paramount Plus. So TKO, which owns UFC, expects the ratings to be much higher for this UFC event than any significant UFC event before, because it's no longer reliant on that pay-per-view paywall. So that is something else I think that we will see this weekend. Again, maybe the winter storm will help ratings on that. Certainly just the debut of UFC on Paramount Plus and CBS should help ratings for that sporting event.
Tuned in sports fans. You got nothing else to do this weekend. All right, Alex Sherman, thank you very much for that. We appreciate it. Have a nice weekend and stay safe out there. All right, and it's a fun one we have for you on Monday as well. Speaking of sports, 3-time major champion in golf Jordan Spieth will join us as the PGA Tour kicks off for this season, for him anyway. So Jordan Spieth coming up on Monday. We'll talk a lot of things about the business of golf and, of course, LIV versus the PGA Tour.
The Dom Chu crib notes are going to be necessary.
We will have a good we'll powwow about
it.
Okay. All right.
Let's get to Julia Boorstin now for the CNBC News Update. Hi, Julia.
Hi, Kelly. A federal judge ruled today the Trump administration must continue funding child care subsidies and other social services programs in 5 democratically run states, at least while the case makes its way through the courts. The Department of Health and Human Services says it was pausing the funding in California, Colorado, Illinois, Minnesota, and New York because it had reason to believe the states were granting the benefits to people in the country illegally. Caroline Ellison is out of federal custody after serving about 14 months for her role in the FTX fraud scandal. She was a star witness in the trial of former FTX CEO Sam Bankman-Fried, who was sentenced to 25 years for defrauding customers and investors out of billions of dollars. The college football playoff 12-team format will remain the same next season after SEC and Big Ten commissioners failed to agree to a compromise for expansion. The SEC pushed for 16 teams, while the Big Ten called for a bracket of up to 24. Playoff officials say the decision to keep the format the same will allow for more time to discuss potential changes in the future. Dom, back over to you.
All right, thank you very much, Julia Boyston, for that. Coming up on the show, the battle over your bets. Prediction markets are disrupting DraftKings and FanDuel, but our next guest says he's still bullish on sports books. Keep it right here. Welcome back. Today marks the 1-year anniversary, right, since a key turning point in sports betting. That's when Kalshi launched its sports predictions market. Since then, shares of sportsbooks operators have gone on a pretty cold streak. Both FanDuel parent company Flutter and DraftKings are down double digits, but our next guest says don't count them out just yet. Joining us now is Needham senior analyst Bernie McTiernan. Why should we not look at the disruptive forces of places like Kalshi and Polymarket and say that they will be the demise of all of these traditional sports books and even the online ones?
Yeah, no, it's a great question and certainly something investors are grappling with right now. And I think the key thing to understand is I actually think prediction markets are going to be an asset for DraftKings and Flutter and even Fanatics, who's going off after this opportunity as well too. And this is pretty much the age-old question that we get with online sports betting, is that as they invest in new markets, so this was a big debate a couple of years ago, if California were to legalize, was it a positive or negative? It's the same thing with prediction markets right now. Flutter said they're going to invest $250 million in prediction markets in 2026. We think DraftKings is going to invest an incremental $200 million. And the question is the ROI on those returns. And in regulated markets, we still think online sports betting offers a better sports product. But this non-sports piece for Kalshi and other prediction markets operator is a substantial opportunity as well too. And so we actually think the TAM for prediction markets is larger than online sports betting, because not only are you dealing with the other half of the country where sports isn't regulated yet, but then you have the whole country where for people 18 to 20-year-olds, and then also the whole country for this non-sports piece as well too, where they're not matching up against DraftKings and FanDuel. But this is certainly that has been the key focus for investors and has been invigorated, especially because of some of the more recent New York handle trends we've seen over the past couple weeks.
I just get too mad talking. I think I'm going to have to pass it back over to Doug. You saw what happened, Bernie, last week, where there were, 40 students from 20 different colleges under investigation, 11 of them already found guilty by the NCAA of fixing games. And we think now we're expanding prediction markets to states where sports betting isn't even legal. We're like in the early days of this, and it's already so bad.
Well, I think part of regulating a service is the integrity services provided. And so, historically when the, Jonte Porter happened in the NBA, it was Sportradar, and there's been examples of Genius Sports helping as well too, the data providers providing integrity services. And so I think, unfortunately, there's always been bad actors in this, and help in legalizing it has, I think, brought it above board and people realizing it. But no doubt, this is something that the leagues have to solve, and I think are working to, and working with the stakeholders and able to.
And really quickly, before we let you go, Bernie, these prediction markets platforms, they operate more nationally and are regulated, if you will, by national regulators as opposed to the states. Just how important is that going to factor into these and the success of those platforms versus, say, the traditional online betting platforms?
Yeah, no, I mean, look, sports betting or investing in sports is legal nationwide now. And so ultimately what we think is going to happen, that's no longer up to state legislators if they want to decide if their constituents can bet on sports or not. They already can. So now it's about if they want the tax revenue or not. And so we think this is really going to be a catalyst for more states to legalize sports in order to get the tax revenue from it. And on a near-term basis, we prefer what we define as the free riders, those that can benefit from the investments that a DraftKings and the FanDuel is making in prediction markets. So to us, that's the data providers. Sportradar and Genius Sports are the two main ones in the public markets. And so that's our preferred way of playing this theme this year.
All right. Thank you, Bernie. All the kids who were doing Bitcoin, they're all in prediction markets now. That's what the other guy said. It's 18 to 20-year-olds. I thought, isn't gambling not even legal till you're 21? These are all college kids. And then they're college kids, they're betting. All right, we got to go. I'm going to calm down in the break, I promise. Bernie, thank you. America's favorite season begins next week, tax season. How much of a break will you really get this year? Details next. It is almost tax time, well, almost, sort of. The IRS will start accepting 2025 income tax returns on Monday. The president has touted several new provisions from the big, beautiful bill in a speech at Davos this week.
In July, we passed the largest tax cuts in American history, including no tax on tips, no tax on overtime, no tax on Social Security for our great seniors.
The question, Sharon Epperson is here now, is to kind of break this all down, Sharon, and give people a sense of what to really expect now.
Well, talking to tax experts, whenever you hear the words no tax, there's usually some caveats there. And there are a lot more details to this that we need to go through, particularly when you're looking at the no tax on tips. A lot of discussion about that and whether that's going to happen. Key thing to know, this is a deduction. It is not going to completely eliminate tax on tips, and it's for qualified tips. So there are some industries that are not going to qualify. Not all tip workers will be eligible. Also, you have to keep in mind that it's up to $25,000 of qualified tip income, and then there are going to be income phase-outs. And that's a key thing, too, with a lot of these deductions we are seeing that are new from the tax bill, that there are going to be some income limits there. Same for overtime pay. People think, okay, overtime pay, I'm going to get a deduction on my wages. Again, it's not all overtime pay where you're not paying tax. It's on that premium pay. So if you get paid time and a half, the deduction's just for that half. So we're talking about $12,500. If you're single, $25,000 is the deduction cap if you're a married couple, and then there are income phase-outs there as well.
I mean, it's no surprise. Every one of these tax provisions throughout the course of American tax law history has had phase-outs or some kind of caps or limits or everything else. I want to know a little bit more because I know that many of our audience collects a Social Security payment. When there is a no tax on Social Security, what are the caveats there?
Well, this deduction actually has nothing to do with Social Security. It has to do with your age. This senior bonus deduction that has gotten a lot of attention is for people who are over the age of 65 or older, and they're able to get a up to $6,000 deduction. Again, there's an income phase out there, $12,000 for married couples. But the key thing to know here is you do not even have to receive Social Security benefits to qualify for this deduction. So it's not on your Social Security benefits. It is a deduction based on your age.
All told, and we know obviously another part of this is the big refund checks that are coming. So usually I think those are on average around $3,000. Is that right? So maybe an extra $700 or $800 this year?
It could vary. Yes. The Tax Foundation says we are expecting individual income tax to be reduced by $129 billion. What that means on average for the taxpayer who is used to getting on average a $3,000 refund check, you could see $300 to $1,000 more. And what that might mean for people who are used to paying, maybe you pay a little less, and maybe if you're fortunate, you don't have to pay at all.
What exactly should our audience be on the lookout for or proactive about for this tax season as we get ready? Because the emails are coming in saying your 1099s are ready. These forms are going to be mailed out shortly or available electronically. What exactly should we be kind of putting together to fully realize what we can from these new tax law changes?
Well, first of all, it's always good to look at what your tax form said last year, what you did, what documents you collected, and make sure you have all of those documents early. They are going to be sticklers for those 1099s, particularly when it comes to crypto. If you were involved in buying, selling that at all, that is definitely something that's going to be looked at more stringently than it has in the past. You also want to make sure that you're paying attention to having the documents that understanding whether or not they're going to be eligible for a deduction or a credit. When we're looking at no tax or you're going to get a tax break or someone tells you could get a tax break on something, know whether or not it's going to reduce your taxable income or actually cut your tax bill dollar for dollar. There's a big difference there.
All right. Sharon, thanks. Appreciate it. Be a complicated one. Sharon Epperson.
Not my favorite time of year, but you know.
You got to do it.
You got to do it. All right. So Sharon just laid out some of those points. You can learn more on tax saving and tax planning strategies by subscribing to Sharon's Money 101 newsletter. Just use that QR code you see on the screen right there, or go to cnbc.com/money101. Don't go anywhere. We got more Power Lunch right after this.
200 million Americans nationwide are bracing for this big storm. In New York City, some forecasts suggest double-digit snowfall, and some bettors are banking on it. Kalshi is pricing in an 81% chance that New York City will get more than 10 inches of snow. Coin flip for more than 15 inches, about a 20% chance it goes above 20, Dom.
So what's curious to me is, I mean, I'm not sure how much we look at these prediction markets sometimes as ways to glean or tea leaves. Are people in a position to know something?
Prediction markets on snow, you can't affect Mother Nature.
Correct. So Mother Nature is the ultimate arbiter, right? There's no predicting, there's no inside information on what's going on. I don't know how many models you can go through for this. What I do know is that a lot of Americans like myself are probably looking at the strategies that they are going to deal with for this. For us, we're going to use
salt.
We don't
there might be a
pre-salt.
salt shortage in New Jersey?
I can tell you right now, I went to a fill up at a gas station this morning. They had a full pallet of snow melt that was gone inside of 2 to 3 hours.
Yeah, exactly.
All of it gone.
So you're waiting. You're charging up the
snow, not snow blowers, leaf blowers, just to take passes every once in a while to get them ready.
I hope it works.
There you go.
I'm just hoping that the flowers come before I need to leave.
There you go.
Stay at home all weekend long. Dom, thanks for being here. Really appreciate it.
Yeah. Have a nice weekend, everyone. Stay safe out there. Thanks for watching Power Lunch.
Closing bell starts now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with stocks in the storm, one acting more volatile lately, the other looking especially vicious as it slams a large part of the country into the weekend. We'll get that update in just a moment. In the meantime, let's show you the scorecard here with 60 to go in regulation. We have been mostly lower throughout most of the day. The Russell getting hit pretty hard today. S&P and the NASDAQ are trying to get something going. And the NASDAQ's been the best of the majors. The Russell's been the best by far year to date, but it's given a little bit back. Intel, it's getting hammered today after giving a very weak outlook. That stock down at the lows of the day, down 18%. Microsoft, Meta, Amazon, they're running a bit as those earnings loom next week. And that takes us to our talk of the tape. The big question hanging over this market, not how good will mega cap earnings be, but how much snow are we getting this weekend? 200 million people in the path of this monster storm. Energy's been moving on it. Prediction markets are abuzz with bets. And AccuWeather's Jeff Cornish joins us now with the very latest. Jeff, what can you tell us?
All right, Scott, this is going to be a very, very high impact event here. The biggest winter storm the central, southern, and eastern U.S. has faced in several years. 200 million of us are going to be affected by this. Travel shut down east of the Rockies into early next week. And one of the big aspects of this storm that will have a lot of implications for life as cold air sets in, we're going to have major freezing rain problems across the south and into the southeast, up into the mid-Atlantic states as well as we move through the next several days. It begins in Dallas this evening and tonight with some rain changing to freezing rain, then sleet, but big-time problems into Atlanta, Charlotte, into the end of the weekend. Heavy snow on the north side. As you mentioned, we're going to be dealing with a hard-hit areas, especially near and west of I-95, hit especially hard. But regarding the ice, here we have that sleet and freezing rain combination that's going to be a very dangerous thing, especially with power outages. That will likely follow near record and record-breaking cold on Sunday. And if you don't have electricity, that's a bad thing there into Texas. We'll see some near-record lows into the Carolinas following that into Monday and Tuesday. And the snowy side, widespread 6 to 12 inches. Zoom into the northeast here in the darker blue zone, 12 to 18 inches into areas near I-81. There's potential that New York City could even see double digits if we don't see any sleet mix in on the backside. Scott?
All right, Jeff, thanks for the update. We appreciate it. Well, we told you, energy's moving. Nat gas is just exploding this week. Pippa Stevens joins us now with more. Breathtaking to look at.
That's right, Scott. And one trader calling it a historic week, and the storm hasn't even begun, meaning we could see more fireworks for nat gas prices, especially with the contract set to roll on Wednesday. The spread between the front month and second month is now $1.76. That is highly unusual and demonstrates the current market tightness. A lot now depends on the direction of the storm and whether energy infrastructure is impacted in the east and south central, with Citi forecasting 80 BCF of supply at risk. Now, this week could see the second largest inventory draw on record. Right now, storage is 6% above the 5-year average. But if February winds up being chilly, the need to refill storage could add price support for injection season and lift gas prices. Scott?
All right, Pippa, thank you for that. That's Pippa Stevens. Phil LeBeau joins us now with how the airlines are preparing for this weekend's massive storm. Hey, Phil.
Hey, Scott, they're issuing travel waivers and canceling a lot of flights in advance. We've already seen some flights canceled today. Primarily, the biggest areas hit are the Central Plains, Dallas, Oklahoma City, even here up here in Chicago. We've noticed this as well. This is FlightAware saying 542 flights canceled so far, more than 2,500 flights delayed. What are the airlines expecting? Here is Alaska Airlines CEO Ben Minicucci talking with us earlier this afternoon about his expectations.
It's going to be ugly. We're taking down our schedule to the East Coast. Now, fortunately, we're on the West Coast, the bulk of our operations, but we got pounded with rain and all that stuff. So we had our stuff as well. But I'm hoping it's not going to be as bad as it is, but it looks pretty dire right now.
Take a look at a couple of charts. We're going to start off with American Airlines. Why? DFW is its hub, and they're already noticing cancellations. That's going to ramp up as we go into Saturday and Sunday and then move to the east. Delta, Alaska, United Airlines, you heard Ben Minicucci talking. They've all been issuing travel waivers. Really, every airline is doing that. And the thing that you need to keep in mind as you take a look at the airline index, Scott, the most impactful storms, the ones that really hit the bottom line for airlines, are those that are unannounced and are open-ended. This is a fast-moving storm. Even though it's big, Scott, it's fast-moving, and the airlines
to go, revealing CEO David Solomon's 2025 pay package. That coming in a regulatory filing. Mr. Solomon receiving $47 million in total compensation, which includes $2 million in base salary and $45 million in incentives. That's an increase from $39 million in 2024 and reflects the really stellar year that Goldman shares have had, up more than 43% over the past 12 months. The firm also posting its second highest net revenues and net earnings for 2025. By contrast, JP Morgan CEO Jamie Dimon paid $43 million last year. That's a 10% increase from the year prior, and those numbers just released yesterday. Tom Lee, as I said, is with me now as we turn back to the markets. He is a CNBC contributor, of course, Fundstrat Global Advisors. So it's good to see you.
Great to see you, Scott.
It's been a turbulent week.
It has.
Is it portend something that's going to come forward here for us?
Well, part of it is, of course, as you know, we're in earnings season and markets tend to be volatile around earnings. I'd say that some of the high-profile declines, like Intel, look bad over a one-day period, but Intel was $17 a year ago. So to me, it doesn't surprise me that you could see some of those stocks have done really well get punished a little bit on earnings.
I mean, this is a hard one to say it's representative of anything. I mean, you know, the company's obviously been challenged. They have the government backstop in there, and the stock was up a ton going into the print. As we turn, speaking of the print, the prints that matter next week, the mega caps, which you still love, but not quite as much?
I mean, we still like the Mag 7 and the mega caps because they're great earnings stories and they have a lot of visibility. But as you know, our top picks this year in terms of sector is energy and basic materials. But as far as earnings stories go, yeah, I think next week's critical because you got most of the Mag 7 reporting.
Tom, you're crushing that so far with that call. Energy and materials are the two top sectors.
Yeah.
Why were you leaning that direction as the year began?
You know, we were betting a bit of mean reversion taking place in 2026. One of the things we identified in our 2026 outlook in early December was that energy and materials underperformed over the last 5 years at a level that in the last 50 years have marked turning points higher. So we were betting that so much of the bad news was baked in that they could have okay fundamental years, but the stocks could do really well.
I feel like you were on the right path as it pertains to small caps and the Russell just a little early. Maybe.
Yeah.
I mean, remember, let's remind people, last year you told me up here that we were going to have a 50% gain in the Russell.
Yeah.
Now, obviously, we didn't have that, but the Russell is almost outperforming everything else over the past year, and in 1 month, it's up 5%.
Yeah.
That going to continue?
Yeah. One of the things we talked about a lot about last year was that when small caps turn, it tends to be a multi-year. In fact, it could be up to a 12-year period. So the last turning point for small caps, and on a relative price to sales last year or price to book, they were at the exact same point they were in 2001. That was a launch point for 12 years of relative outperformance. So I think small caps benefit from a Fed turning dovish, possible M&A wave coming, an ISM turning back above 50, and then catching up to where EM, because EM did really well last year, but and small caps usually track that. It didn't.
Fed turning dovish. You know, we have a meeting next week, in case you didn't know, and not expected to do anything. So maybe not as dovish as people thought several months ago. And by the way, as we look at prediction markets, as we think about who might be the next Fed chair, BlackRock's Rick Rieder is now the leading contender in prediction markets. There's Kalshi. We, of course, have a partnership with them. 52% leaning towards Rick Rieder. We shall see. Do you care how much you think about who the next might be?
I mean, it's important because it reflects the market. Market needs to respect who the new Fed chair is. Rick Rieder is somebody that markets really do respect. So, as you know, the Fed has to communicate not only with the White House, but also with the bond market. And I think Rick Rieder's experience in the markets world makes him very credible.
But you're not expecting anything next week, right?
I'm not, but I'm also expecting the Fed to reiterate that they are focused on no longer fighting inflation, but looking at the job market. That's a Fed put on the economy. To me, that's a dovish tilt. And as long as they're not fighting inflation, to me, that's a dovish Fed.
And that's why you think the equal weight S&P is up 4% so far this year compared to the S&P, which is up 1%, and the NASDAQ, which is only up 1.5%?
Yeah, I think so, because as you know, not only is the Fed no longer is trying to establish inflation credibility, which is hawkish, QT has ended, which to me is the same as a version of QE starting. So we are facing a dovish Fed. Even if there aren't cuts, it's still a Fed that wants the economy to do well.
I'm not sure everybody sees every appearance that you have, and people generally think you skew bullish, which you obviously do. That said, you're still looking for what you've said could be a bear market in the middle of the year. Do you want to explain one more time why, even in the midst of this bullishness we hear from you, you still think stocks could have a bit of a rocky road at some point?
Yeah, I think 2026 has the same contours as last year. So in 2026, I think there's a good fundamental earnings story, earnings growth accelerating. But we have two transitions to deal with. One is the Fed, a new Fed. The market always tests a new Fed. So from confirmation, let's say that starts in March, a new Fed happens, and then the market tests him. That's one source of a drawdown. The second is, of course, policy. The White House is much more deliberate this year in picking winners and losers, and there's some uncertainty around the tariffs. Last year, that was enough to drive a 20% decline in the S&P. So I think the combination of policy uncertainty along with Fed could create a drawdown that feels like a bear market, but that's from higher levels as well.
Did it make you nervous, the events of earlier this week, speaking of policy uncertainty? You just don't really know what's coming anywhere, for that matter, whether social media or policy by post or what have you. What did you learn, if anything, about Tuesday's events and then how the market acted subsequently?
Well, I think it's a prelude to what a bigger drawdown looks like, because just a social media post about Denmark caused a 2% decline in the S&P and a spike in the VIX. And that was, of course, quickly diffused. But imagine a scenario where there's a series of policy headlines that markets get anxious about. It could easily lead to a larger drawdown.
Which some expect more volatility. Let's find out what others think as well. Let's bring in Keith Lerner. He is of Truist Wealth and a CNBC contributor, Malcolm Etheridge of Capital Area Planning. Guys, good to have you. What about that, Malcolm? More volatility ahead after this turbulent week?
Yeah, I think we're certainly in for some volatility, not only through the entire year, but possibly this quarter. I don't think that Greenland is necessarily a settled case. I don't think that all of the president's agenda that he's going to want to get enacted before the midterms happen. I don't think we've heard the last of it, and Tom makes a great point about years where a new Fed chair comes in and what the market's reaction is to that. For some of that volatility, if any of the four Mag 7 companies that we're scheduled to hear from, Microsoft, Apple, Tesla, and I'm blanking on the fourth one, sorry, but that's 15% of the
Apple.
S&P 500's. Apple, thank you. I don't know how I could forget them. But that's 15% of the S&P 500's weighting, and that is very important because it's going to determine whether the rotation away from tech continues, or if we hear guidance from those four companies that backs up what we heard from TSMC a little bit ago, that basically bookings are sold out through the entire year, and the money that these companies have been spending is not going to slow down anytime soon. That is very helpful for materials, construction, utilities, those kinds of names. And so I think it helps to keep the party going within tech. Or if we do hear some weakness in that guidance, maybe it starts to show that more of a rotation into IWM, the small caps, things like that Tom's getting excited about.
Isn't it interesting that you forgot to mention Apple? The stock's poised for 8 straight down weeks. A lot of investors have forgot about it lately because it hasn't given them, Malcolm, much reason to think about it. Certainly, relative to what their AI story has been, and when you compare it to some of the other names.
Well, yeah, and it's also very telling that Apple has decided to, I won't say throw in the towel, but go in a different direction and work with Google once again for their AI platform, for their AI build into the iPhone. So I have the iPhone 16, the 17. We're also told that Apple Intelligence was supposed to be the thing to really start to turn the corner, and it seems as if either they're delaying that or they've completely stepped away from Apple Intelligence being the thing to really power the device, and now they're focused on partnering with names like Google and others to help bring that along, and that's really disappointing to Apple shareholders like myself.
Keith, what's at stake, do you think, next week? I mean, this happens at an interesting time where these stocks, for a change, are not leading going into their prints in many respects.
Yeah, great to be with you and to join the discussion. So, I mean, I agree with some of the points were brought up. I mean, so far we've had this really consensus rotation into everything but tech. Tech's down for the year. But, as I think about this, Scott, and I zoom out a little bit, the technology sector was up more than 70% off the lows. And I think the last 2 or 3 months has been a consolidation. I was just looking this morning. I found it interesting that the tech sector is now trading at a premium of just 16% relative to the S&P. That's the lowest since 2021, and it's well off the premium of about 36 or 37% that we saw just a few months ago. So we are still positive on tech. It is a critical week. With sentiment now more subdued, expectations are lower. So what we want to see is that these names clear this lowered bar as we go into a really jam-packed week of tech earnings.
Would you be overweight the group, or would you now lean more heavily towards the rest of the market?
So what we've done, we still have a legacy overweight to tech and communications, but we were with you in mid-December when we upgraded the industrial sector, the energy sector, and materials. And our philosophy today is we still like these other areas long-term, but it doesn't have to be either or. We still like them. They've been out of favor, but we still think as this market broadens and we have an uptick in the economy, that these other areas should be able to participate. And it's going to be hard to catch all these rotations back and forth, right? So why not have some of both? And that's where we stand today.
Tom, I mean, we're going to be reminded of something next week. Either reminded why we lean so heavily into these names, or reminded why we've started to move in other directions in the market.
Yeah. I mean, and it could be a mixed bag that I think you might have some tech names do really well because they're surprising and they're reiterating guidance, and maybe there's a couple stumbles here and there. But to me, it's still, as a group, linked to the AI trade, and I think it's still a central driver of not only U.S. but global GDP.
This sucks a lot of oxygen out of the room, guys. I'm aware of that, but let's move to some other areas of the market that I want to get your takes on. Malcolm, gold, it's just about at 5,000. Silver's at 100. I mean, these are record levels for both. How do you feel about clients getting exposure there if they don't already have? Are you a believer that the trend just continues to move higher?
I do. I think that we go from 5,000 and then we start talking about when do we see 6,000, because the angst in the markets that we're talking about, it's not going away. And it's also not going into the 10-year Treasury the way we historically would expect it to do, with yields continuing to rise. And so I think that gold more than likely continues to be the safety trade globally for investors who are either selling away from America or U.S. investors who are also thinking maybe I ought to be looking somewhere outside of the S&P 500.
Keith, what is this about, this move towards 5,000 and perhaps beyond, as Malcolm suggests it could go?
Yeah, I think it's a combination of things. I think today we're seeing the dollar a little bit weak. Central banks are buying some diversification outside of the U.S. We've been bullish on gold all last year, and we still are this year. I will note, at least on a short-term basis, I do think these trades are getting a little bit stretched. And with commodities, momentum often begets momentum. So you don't want to try to call a top, but when we look seen since the Hunt brothers in 79 and 80. And when we've seen about 5 other circumstances when it's gotten this stretch, and sometimes it does continue to move forward, the next few months, but 12 to 18 months, the risk reward has been less favorable. Now, obviously the dynamics that's causing that may be a little bit different, but at this point, we're telling our clients we still prefer, we would prefer gold from a portfolio diversification standpoint. And we don't think the risk reward is that compelling here for silver. So we'd be patient for a pullback, even realizing that may come from a higher level.
Tom, gold, I'll tell you what, looks a heck of a lot better right now than the alleged digital gold, Bitcoin. What's going on there? Risk on, it doesn't really do anything now. Risk off, it doesn't do anything either. What's it correlated to, if anything?
I think crypto has been suffering from deleveraging. In October 10th, there was that one-time price shock that was the biggest deleveraging of crypto in history. And then this week, crypto was doing well until the Greenland announcement, which triggered the move in JGB yields and a deleveraging in crypto. So I think crypto, unfortunately, is sort of would track gold, but you have to subtract deleveraging, and I think that's really what's been hurting crypto.
I mean, these calls it, it's the the new reserve currency. Break out the gong on that. That it's the new gold. Break out the gong on that. I mean. Have you rethought where you thought that this could go over a period of time? Because your targets on it were so unbelievably lofty, and now I question as to whether they could ever be reached.
Yeah, well, I think Davos was pretty eye-opening. Larry Fink talked about everything being tokenized onto a common blockchain. David Sachs talks about how once the Clarity Act's passed, digital assets and basically the architecture of Wall Street are going to merge. I think crypto is still really relevant as a settlement layer, but it is more a story of.
All right, team, I'm gonna go ahead and shut it down for the day. Hope everybody has a good weekend. Please be safe. Please be safe. And I'm gonna keep you in your prayers. Keep me in yours. God willing, we will reconvene on Monday, inshallah.
Legacy wallets. I don't think Bitcoin's story is broken. I think it is waiting for clarity, but institutional adoption's growing. So I still don't think $200,000 Bitcoin is that crazy. It is just a doubling in price. And think about where gold was and how silver's moved. Historically,